Hey Samfam, this is Ria from Samaya, and have you all been writing your examinations and you have already completed two? This half of your first group and heading over to the toughest examination for the group one audit. And if you have done very good and you have been satisfied with your performance in your previous two examination and you're great for that, and I'm very happy for you. And just with the same Josh, move on to the audit phase also and just complete audit and law and go out with the blooming colors and all. Just have satisfied examination. And if you haven't done well or you haven't satisfied with your performance, don't worry for that. You still have two balls in your court. Listen to this frantic cover. We'll just be covering up 60 to 65% of the audit portion in the 20% of the time you have. Okay. We'll be discussing MCQs, important questions, all the amendments, and all the questions, the descriptive questions also. And with that said, tomorrow when you wake up, you need not read anything for today. You just listen, sit back, listen, take a bath, and listen to the frantic cover and just sleep and let your subconscious mind work for this all the information that have been reading it today, right? And tomorrow your revision, start your revision early morning, and you'll be completing your revision on a very fast pace. Because of this frantic cover, will be covering almost all important questions which would carry almost 80% of your marks. Okay, with that said, we'll just move on to our first topic, that is disclosure requirements. And our first topic under disclosures were related party disclosures. There was an amendment with regards to this. These were the additional requirements apart from the Schedule 5 requirements. We have under Audit Committee and Corporate Governance, we have few disclosures with regard to Schedule 5. We'll be discussing that in a while. And these were the additional requirements for that. And these were with regards to, they have to submit the disclosures with regards to the related party transactions and all the parties to the stock exchanges, right? These were the due dates we'll be discussing after these. Okay. What are the additional requirements? Additional disclosures were loans and advances in the nature of loans to its subsidiaries, associates, or firms or companies in which directors were interested. There were three or four portions here, 4 points. First one is subsidiaries, associates, and firms in which directors were interested, and companies in which directors are interested. I have given it like in a slash because it would be easier for you to understand. But whenever you have to write in your examination, you have to repeat the same point 4 times for the four parties. Okay, subsidiaries, associates, firms in which directors are interested, and companies in which directors are interested. By what you have to disclose their name and their amount of the loans or advances which we have given, the company had given to those entities. Okay. And second thing is investments by loanee in shares of the parent company and its subsidiaries. When to whom we have given the loan, subsidiaries, associates, and firms and our companies, right? Whether they have made any investments in our company or our subsidiary company or a parent company, we have to give disclosures with regards to that. And whether we have taken any transactions with that entity belonging to the promoter or group which holds 10% or more shareholding to that person. You see, this is an entity they're talking about here. And with any person who is holding or entity who is holding shares of more than 10% or equal to 10%, that is when it touches 10%, you have to give disclosures. Okay. And you have to give disclosures in the annual report. And with regards to the related party transactions, every listed entity has to submit to the stock exchanges the related party transactions or the related party or relationships, right? And we'll see amendments. There were few amendments with regards to that have come. We'll also see those amendments here. Listed entities required to formulate a policy on related party transactions and review by the board of directors at least once in every 3 years. Okay, what they have to do, they have to formulate a policy on regards to the related party transactions and review by the board of director once in 3 years. Okay, once in 3 years. Related party transaction shall be considered material exceeds rupees 1000 crores or 10% of the annual consolidated turnover. You see, there was no separate committee for the related party transactions. Audit committee only reviews those policies and all. For the related party transaction, in order to be a material, in order to be a material and which was some special disclosures in the board of directors or special highlighting point with regards to the audit committee disclosures, etc., or reporting requirements by audit committee and all. What all the when we call a related party transactions a material related party transaction, when the amount of that exceeds, that is when it touches 1000 cr or 10%, whichever is would be lower, would not be a material transactions. When it exceeds, okay, when it touches 1000 cr, it's not a material transaction. When it exceeds 1000 cr or 10% of consolidated revenue, whichever is lower, there's an absolute term here and a relative term here. Whenever there was an absolute and a relative term, the minimum portion of that had a whichever is lower one and which exceeds that. Okay, this format would often repeat in the amendments, all the amendments and the time limits portion also. If you want, you check the time limits video. And we have discussed how we have discussed on blunt rule for which would touch the limit on which would exceed that limit. Okay, and here when they were given on absolute and a relative portion, and they have been comparing for that whichever is lower for the minimum amount, that that amount exceeds that, not when it touches. Okay, and with that said, they have to require prior approval. Why we have to check whether it's a material or not? Because for that, if it's a material, they need to require a prior approval from the audit committee, and the audit committee may grant omnibus approval. What is omnibus approval? It's like putting in if conditions. In Excel sheet, we will do some if conditions, right? The same thing. If it is that much amount, if it is, they have done give at this price and all about with regards to the if conditions. They are giving if conditions through the terms and conditions that were already made by the board of directors. Okay, and the listed entity shall submit to stock exchanges all the related disclosures and all for every 6 months within 15 days from the date of publications. And if it's a high value debt listed entity, that is having a thin capitalization along with its standard financial statements for every half year. Okay, and these were with regards to related parties, relationships and transactions, and these were the additional disclosures with regards to related party disclosures in the annual report. Apart from that, or in addition to the Schedule 5 disclosures. What are Schedule 5 disclosures? We'll see here. This is what Schedule 5 disclosures. What are under related parties? There are 4 categories under Schedule 5, mainly in our syllabus. First, we'll see related party disclosures, and then we'll move on to the further things. Okay. What are the requirements as per Schedule 5 under related parties? These were actual disclosure requirements. What we have seen before were all the investments and all the name and the amount of the investment and the 10%, all that shareholding was there, right? Those were the additional requirements. First, we'll see the what they have to do. They have to submit quarterly compliance report on corporate governance in a specified format by the board. Okay, they have to submit a quarterly compliance report to the stock exchanges. All the related party disclosures or related party transaction have to be submitted to the stock exchanges. Okay, details of all material transactions and related party disclosures and the report shall be signed either by the compliance officer or CEO of the listed entity. You see, there were only 2 points here. They have to submit quarterly compliance to the stock exchanges, and with regards to the details of all material transactions. What all material transactions exceeds 1000 CR or 10% of CF or consolidated turnover, right? Whichever is lower for that. And you have to remember that. That's a and the report shall be signed by compliance officer or the CEO and disclose the policy. What we have already seen, there have to be a policy that has to be framed by the board of directors and have to be reviewed for at least once in 3 years. They're talking about they also have to disclose the policies with regards to that, and the disclosure of transactions which we have seen earlier, and the listed entity shall submit within 30 days from the date of publication of its standalone financial statements for the half year and disclosures to the consolidated basis. And this is the amendment here. This is not 30 days, it's 15 days from the end of the 6 months, exceeding 6 months and all. They have converted this into half year into 6 months portion. Okay, with that said, we have completed our related party disclosures, and we'll see other disclosures under Schedule 5. Disclosures and transparency under Regulation 4. What are they talking about? They're talking about how the management have to behave with regards to the disclosure requirements. First, they have to ensure a timely and accurate disclosures in all material matters. What are material matters with regards to any material transaction that we have seen earlier, or with regards to any changes in the ownership or any other significant matters could be disclosed in the following manner. How they have to be done. The information shall be prepared and disclosed as per standards on accounting and financial and non-financial disclosure requirements. Why only standards on accounting, not on standards of auditing? Because standards on auditing have to be followed by the auditor who does the audit. What do management do? Management responsibility lies only in preparation of financial statement. So, what the management has to follow standards on accounting. And obviously, since it's talking about the disclosures, all the financial and non financial disclosures, and the channels of disseminating. Disseminating is like diversification. Your channels of diversified information should be provided for equal, timely, and cost effective access to relevant information by users. You see, users, we like investors or shareholders would require some information that with regards to any kind of matters that were going in the company, right? Like same like a right for information for the government of India, like that also the company also have to give some information with to the users of the financial statements of the information on an equal, timely, on a cost effective manner. Like we have discussed in our monetary limits, like for an LLP inspection copies, it is page or it is rupees 5 per page or something, etc., right? They were talking exactly the same way. They're talking exactly about the same thing here, and the minutes of the meeting shall be maintained explicitly recording dissenting opinions. You see, any board resolution having a special resolution or like for ordinary resolution, there were also some dissenting options with regards to the opinion for that their point of view. In the minutes of the meeting, you also have to record not only the favorable conditions or favorable things, you also have to write the dissenting opinions also. Okay, these were with regards to the informations or disclosures with regards to the management has to follow with regards to disclosures. And disclosures for the accounting treatment, what all they have to follow. Whether in preparation of financial statement, a treatment different from the prescribed accounting standard. That's they have to talk about the deviations in the accounting standard and their financial impact and why they have done that so. Okay. And auditor should refer to that in the compliance of the regulation. This is not an actually disclosure requirement. All the things they have to disclose is all the deviations in the accounting standard. And disclosures in relation to the sexual harassment of women at workplace in Prevention, Prohibition and Redressal Act. You could also see that as a POSH Act, POSH Act, under questions, any kind of questions in question paper. Don't get confused whenever you see POSH Act, POSH Act. It is with regards to these disclosures. Okay, what all the things the company has to disclose? They have to disclose in its annual report the number of complaints filed during the year and the number of complaints disposed during the year and the number of complaints that were pending during the year, that were company client sorry, complaints that were filed and the complaints that were disposed of where a resolution had been or like an what like a decision has been taken with regards to that complaints and the complaints that were pending. These are all the three things you have to give as a disclosures, and that's it. And we have completed with regards to that, and we'll see few specific disclosures in insurance companies. Okay, they were why not insurance companies disclosures also. These were the disclosures with regards to contingent liabilities under insurance companies. Okay, contingent liabilities, what you all you have to disclose. You have to disclose the paid up, partly paid up investments, or you see something you have to by heart is contingent liabilities under Insurance Act. You have to compulsorily know this. Okay, read this. Okay, this was widely tested in MCQs, case scenarios, descriptive questions, whatnot. You have to just remember these. What all comes under contingent liabilities? Partly paid up investments. underwriting commitments outstanding. Why partly paid up investment? Because we have taken some commitment to invest that. We have just same thing like calls in the share capital for few things, right? We all liable to pay or to make that investment. So for that, there was a liability. So, and underwriting commitments outstanding and claims that were are not acknowledged as debts. And if it was already acknowledged as debts, they were need not be disclosed under contingent liabilities. They were already there in the financial statements. Okay, guarantees that were given on behalf of the company. This is a most significant matter where companies collapse, right? Giving guarantees. So already you should give disclosures with regards to that, and any kind of statutory liabilities or demands, and any, since it's an insurance company, this point has been added, reinsurance obligation to the extent not provided in accounts. Whether they have been provided in accounts, you need not give a disclosure. They were already in the financial statements. Okay, and all the actuarial assumptions and the commitments with regards to the outstanding of loans and encumbrances for any assets. Encumbrances, charging of any assets, and kind of amortization of the debt securities and claims settled and remaining unpaid for the period for more than 6 months on closing date. That is, the insurance company have to pay the claims that have been settled within a certain number of time period. That is 30 days, if I'm not wrong. Do cross refer in the time limits PDF that was available in the Telegram channel. And if you haven't claimed that, you haven't paid those settled claims for more than 6 months, you have to give a disclosures why you haven't paid that. And the value of contracts in relation to investment for purchase where deliveries are pending and sales where payments are overdue. What they're talking is, under insurance company, when we settle claims, we give money to the insurer. Then what we'll do? We'll just acquire all the like the property, etc., right? And then we sell that in an auction. What are they talking about? They're talking about the same thing. It and not only this, with regards to also financial instruments, and opening operating expenses with regards to on the base of allocation of expenses to the various segments of business, and computation of managerial remuneration. This is an important disclosure, and historical cost of those investments valued at fair value basis. This is also an important point, and a basis of revaluation of investment property. And with that said, and now we'll move on to general instructions of financial statements. And this is often closely related to disclosure requirements. We'll just see that once. And all the Schedule 3. You see, Schedule 3 have been very widely asked in the RTPs and MTPs. Do check that out. And anyways, we are discussing it here. You need not, you just remember that's it. Or you may take screenshot of this, what I'm talking about. And these were few general instructions that were often asked. It was mostly asked in last, like we'll see few or questions, right? In that or question, there'll be a particular question with regards to general instructions for preparation of balance sheet and financial statements, etc. For that, you could write this. And once you, they were like, it repeats 4 to 5 times, but every time it was the same thing. Okay, for if it's for a balance sheet or a P&L account for both Ind AS, AS, everything deals about the same thing. Okay, if you read one time, it would be more than enough. And now we'll just see those points. And an asset shall be classified as current when it satisfies these three things. Okay, it is realized in normal operating cycle. Okay, it is primarily for the purpose of trading, and it's expected to be realized within 12 months. Okay, they have talking about assets, so they have asked that they would be realized in the normal operating cycle. If it's a liability, it is that it has to be settled within normal operating cycle, and held for primarily for trading. That was fine, quite good for both assets and liabilities. And for the liability, it is expected to be settled within 12 months. Since it's an asset, they have been said that it's realized within 12 months. Since it's liability, it have to be, you have to write it as settled within 12 months. You see the same thing with regards to the liability. Okay, and that's it. We have completed two bigger points. Okay, And now, what is an operating cycle? Operating cycle mostly where the time between acquisition of assets for processing and realization of cash and cash equivalents. With regards to assets, what they're talking about the stocking trade. Okay, and the where you realize the cash from acquiring, from acquisition to realizing of cash. When you cannot find, the normal operating cycle would be assumed as a duration of 12 months. Okay, and if it's a receivable, it shall be classified as a trade receivable when it's in normal course of business. When it's a payable, it has to be treated as a trade payable when the amount was due on account of goods purchased or services received in the normal course of business. And these were all the 5 points. You could just write it anywhere whenever they ask for general instruction for preparation of financial statement, balance sheet, etc., whether it's AS or Ind AS. Okay. And now we'll see few disclosure requirements, sorry, few notes how to disclose. So these were the disclosure requirements under the financial statements under Schedule 3. We have seen under Schedule 5, right? These were the disclosure requirements under Schedule 3. With regards to the share capital, what we have to do. You see, when for disclosure requirements, you need not by heart anything in so special. Where you already have completed the financial FR, right? Financial reporting paper. What all the things you have you have written in your answer sheet, you have to disclose the same thing in the preparation of share capital. What you have written in the question, all the authorized share capital and all the fully paid up share capital where there were any changes in the share capital or shareholding or the ownership, and what's the face value of the share capital, whether they have issued any premiums, what all the securities premiums, and whether with regards to securities premium, whether the purposes were have been utilized for the same 5 to 6 purposes that have been restricted to that. And any kind of with regards to the shareholders were the parties involved, or whether there were any kind of what are promoters shareholding, and what else with regards to have given like shareholders which are holding more than 5% of the shareholding, and you also could give shares to the employees in form of sweat equity shares, and for share based payments in days 1 or 2, all the equity shares you have been given under those schemes and etc. And there were any kind of debt reconstruction or tribunal have asked for compulsory acquisition and all, you have to give all those disclosures, and that's it. You see, right equity shares, preference, restrictions attached to those, and each shareholder. This is a one point that you have to remember and specific apart from these general things. Okay. And shareholder, you see, every disclosures for everything was in the syllabus and everything we knew. You just have to put it on the paper. That's it. And shareholding for more than 5% and the number of shares held and options or commitments, etc. And for the period of 5 years immediately preceding the date of financial statements prepared, the aggregate number and class of shares allotted as a fully paid up and pursuant to the contracts without payment being received in cash, all the share based payments, and the aggregate number of shares allotted for fully paid up by way of bonus shares and buyback of shares for a period of 5 years immediately preceding the balance sheet date. You have to remember in specific this if they have asked for more marks. Okay, otherwise you just could easily skip that and you could write all the other things, all the calls unpaid and forfeited shares, everything with related to share capital. And now they have asked in MTPs with regards to the borrowings. You have to remember these disclosures that what we are talking about. All the long-term borrowing shall be classified as bonds, debentures. Okay, first thing. Then term loans from banks or other parties, deferred payment liabilities, deposits. You see, remember these four in one category. Okay, with a D deposits, you have to complete one category. First, A, bonds and debentures. All this B comes like this, right? B comes in a cross manner. This B doesn't come here to the B clause. Bonds, AB. Bonds or debentures, B. Term loans from two portions. Since second options, two options from banks and other payments. C. CD. Deferred payments and liabilities. DD. Deposits. Okay, this is one category. A. Bonds or, repeat after me. A. Bonds or debentures. B. term loans from banks or from other parties. CD, deferred payment liabilities. DD, deposits. Okay. And now, with regards to loans and advances from related parties, long-term maturities of financial lease obligations, and other loans and advances. Related parties come first, and F for finance lease obligations. Okay, these 2 points you have to remember extra. That's it. A, B, bonds and debentures. B have two options with regards to term loans from banks and other parties. C, deferred payment liabilities. D, deposits. E, with regards to related parties, and F with regards to long-term maturities of finance lease obligations and other parties. And that's it. You have to remember these points. They have been asked by ICI. It's an important question. And following shall be further subclassified as secured or unsecured on base of nature of security, and with regards to any kind of guarantees, or with regards to, that's it. You need not remember these all. You could and the repayment terms, etc. What all the things you have to remember is this things. Okay, this first point, and with regards to repayment and guarantees that they have taken, and etc. And that's it. We'll just move on to the next important topic, and it's also the same for the short-term liabilities, or short-term borrowings also. But what's more important is the long-term borrowings. Okay, and with regards to trade payables for the MSMEs were also an important disclosures you have to give. The principal amount and the interest due remaining unpaid by any supplier for the end of each accounting year. The principal and the interest amount that you have due to an MSME supplier for the each accounting year end, that we have to disclose here. And with regards to the interest that have been paid after the appointed day, that was there's a due date in the MSME Act that within which we have to pay, and we have paid beyond that period. Okay, we have to give that one. And the amount of interest due and payable for the period of delay in making payment, not with regards to such amount outstanding, but for the delay in payment of that. They have the interest that have been paid beyond that date, and interest on interest for delay in making payment have to be given here. The principal amount and the interest. Principal amount, say it's like any kind of amount that was outstanding, let it be by any trade loans or with regards to any kind of purchases, etc. That principal amount and interest that were due for the year ended, and the interest that was paid beyond the day that was specified in the MSME Act, and the interest on the interest that was paid beyond the due date for delay in making payment, that interest have to be given. All the three has to be given. And the interest that was accrued and remaining unpaid, that's the outstanding interest, also have to be mentioned, and the amount of interest remaining undue and payable even in the succeeding year until such date when interest dues are actually paid to the small enterprises. Okay, these were all the disclosures with regards to the interest with regards to that. Okay, and this is a schedule. This is a format that has to be remembered. Trade payables aging schedule. This is a very important thing. MSMEs, others. Third one is disputed dues with regards to MSMEs, and disputed dues and others. Okay, there were only four things, no fifth point. This had been or error in the tapping error. The only four things: MSMEs, others, and the third one is disputed dues MSMEs and disputed dues others. Less than 1 year, 1 to 2 years, and 2 to 3, more than 3, and aggregate of that. You have to remember like that. Okay. And with that said, we'll just move on to the PPE. This is also again an important disclosure requirement. What all you have to do: lands, buildings, PPE, furniture, vehicles, office equipment, and others. Land, buildings, PPE, furniture, vehicles. First, we'll buy land, then we'll make buildings on that. And in buildings, we'll put what the plant and machinery which were required for making the goods that we require in our factory, and furniture for the all the what like bios for of others to sit. What are we doing now? We are making a story in order to remember this. First, we'll purchase a land, then we'll construct a factory building, and we'll install plant and machinery and purchase some say like toys. And what all the customers come, we have to give some furniture with regards to them to sit. And after they sit and they have ordered in bulk, so we have to buy some vehicles, delivery vehicles, to purchase or to deliver all the purchased toys to their store. Okay, and then after that delivery, we have to what like make some office equipment, well, like computer to raise invoice, or like for record in the books of accounts, record in books of accounts, right? The office equipment and others. With this small story, you could just remember this. And assets under lease and the reconciliations with regards to that, and any change in revaluation for 10% or more, and assets written off. That's it. These are all the things you have to remember in case of PPE. And with that said, we'll just move on to the intangible assets. Intangible assets, all the same thing. And also again important thing, all the goodwill and brands or trademarks, computer software. How it was asked is that they'll give few options, four options, of whether this includes in intangible assets or not. Remember that brands and mastheads and publishing titles and mining rights, copyrights, these were also includes in the intangible assets. Apart from this, brand mascots also, like I am Ria, a brand mascot of Samaya. I'm also an intellectual property of the Samaya. Okay, like this, even the brand mascots, like any figure that was representing the brand is a brand mascot. Okay, they were talking about this here. Okay, and that's it. And what the again important thing is trade receivables aging schedule. This is less than 6 months. We have seen trade payables that is less than 1 year, and this is trade receivables is less than 6 months. Remember, there's a difference with regards to that. Okay, and 1 to 2 years, 2 to 3, more than 3 years were the same, but for that less than 1 year for the trade receivables, that is 6 months and 1 year, they have segregated into two portions. We'll see again the four things. Undisputed trade receivables considered good. Okay, trade receivables that were good, trade receivables which are doubtful. Trade receivables which were disputed were good, and disputed which were doubtful. That's it. Okay, MSME others. Here, trade receivables that were good and that were doubtful, and disputed which were good, and disputed which were doubtful. And with that said, we'll just go with trade receivables aging schedule. What the trade receivables here we are. This is under the non-current heading, and the trade receivable that we are here seen here is under current schedule. Okay, and this is again an important disclosure requirement with regards to cash and cash equivalents, that is balance with banks, checks, drafts on hand, and check cash on hand and others, and earmarked balances with banks, and balance with banks to the extent of margin money, security against borrowings, guarantees, and other commitments. You have to remember this. Okay, read it 2 to 3 times, and that's it. You're good to go. And with that said, and these were, as already we have discussed in the insurance also, with regards to disclosures in the insurance company, almost the same thing. If you read that, eliminate all the insurance specific points, and you're good to go with the disclosures of contingent liabilities also. Okay, and that's it. You see, you need not remember every single detail. You have to remember the additions and deletions. Audit is often done in the same way for the financial statement, but there were few specific points for the few entities. That's it. And with regards to Binami parties held, you see, these were not discussed in the MTPs and RTPs, but they were just highlighted. You could get this in the Telegram channel also, just to quickly go through what are all the important topics and all for the Binami party transactions. And here, when the title deeds, when company had bought some any kind of immovable property, but not in the name of the company, on name of some other third party else, there would be a clash between the Binami party transactions and the title deeds which were not in the name of the company. You have to remember these 2 points. They would be asked that you have to remember the disclosures. They could ask like what is the difference between the company that had bought the immovable property in other names and on the Binami party transactions. Okay, you all have to remember the disclosure requirements with regards to that, and you have to what are the disclosures you have to give when they have main not bought the property on the name of the company. What's the reason for that, on the person whom how the person was related, and all the things you have to write. And apart from the disclosures with which we give to the purchase of the immobile property, these were the additional disclosures. And these were the Binami party transactions disclosures, all the property that was there and amount and details of the beneficiaries, who was the original owner, and which were in the books and which were not in the books. One, you have to give it the reasons and the willful defaulter. And with regards to any company which has been declared as a willful defaulter by any kind of bank or financial institution, we have to disclose the date of declaration and what all the defaults that we have made. And we have to also disclose the relationship parties with regards to the stock of companies, or in what all the ways we have related, whether we have given any kind of loan or we have made any investments, or we are trade payables or trade receivables, etc. And with regards to the compliance of number of layers of entities, or you have to also just give a disclosure. I'm just giving this so that there was a give you a like an acknowledgement that it's also there in the disclosure requirements, which we often forget. Okay, and these were the ratios which you have to remember. Just read it once, that's it. Obviously, debt equity ratio. Coming to the balance sheet, what we have equity, we have assets and debt, right? We have to do what? We have to first do debt equity ratio and the service cover ratio, return on equity, and come to the current assets in inventory turnover ratio, the coming to P&L. And with regards to the current assets, trade receivables turnover ratio, trade payables turnover ratio. You could remember all these three in one go. Okay, net capital cover ratio, capital turnover ratio, net profit ratio, and return on capital employed, return on investment. And you also have to give disclosures if the preceding year have been changed. There was a change with more than 25%. If it's 25%, not required. If it's more than 25%, you have to give reasons for that. And regards to profit and loss, there was not so many important points with regards to P&L disclosures, and there were only some highlighted points like CSR, the amount that were required to be expensed and the amount that was expended, and whether and there were any shortfall for that, and reasons for those shortfall, and the nature of CSR activities that have been taken, and were all the related party transactions that have been given. Also, you see, CSR activities or CSR expenditure was not allowed as an expenditure in the financial statement. So there could be chances that it would be used for the benefit of the promoters itself. So you also have to give details with regards to related party transactions, like you have given contributed to any trust in which the promoter or any kind of director have been a trustee. Okay, you also have to give that. And again, disclosures with regards to cryptocurrency is what all the company has to disclose: profit or loss on those transactions involving cryptocurrency or virtual currency, and the amount of currency held as at reporting date, and deposits or advances from any person for the purpose of trading of cryptocurrency. First thing, what all they have to disclose: three things. What all those, any P&L, what the profit or loss that were realized in the trading of such cryptos, and amount of currency that were held, that is as on the balance sheet date, and whether they have taken any kind of loans or advances or deposits for investing or trading such cryptos. Okay, all the 3 points they have to disclose. The source you have to disclose, and the profit or loss from those transactions, and the amount as held as on the date of balance sheet date. And any kind of undisclosed income you have to disclose. And that's it with regards to the P&L account. Only this you have to disclose. And that's it. It again repeats with the same as for the Ind-AS. Also the same thing you see here with the general instructions of the balance sheet. It was same for AS and Ind-AS, and there's nothing new for that. And the same as with regards to PPE, etc. And we are not discussing in detail for that. And specific disclosures with regards to only for specific for Ind-AS were OCI income. With regards to that, OCI income, where see, you have recently completed your offer paper, so you have to say before that name. Okay, items that will not be reclassified as a P&L account. Okay, changes, revaluation, surplus, remeasurements in definite benefit plan instruments through OCI, fair value changes with regards to own credit risk financial liabilities ascertained at fair value through P&L account, and share of OCI in associates or joint ventures which are not classified into P&L account. And they have just copy pasted the same thing here. I don't. And others, and the items that were reclassified into P&L account, what all they have to give. Exchange differences with regards to any kind of foreign operations, debt instruments through OCI, and the effective portion of gains or losses on hedging instruments, and shares of OCI in joint associates or joint ventures to the extent classified as P&L account, and others. The fourth point and first point were the same for the above and all the below also, and what all the additional disclosures were. These were employee benefits and etc. and any income or expenditure which exceeds 1% or 10 lakh, whichever is higher. You see, whenever we have said there's an absolute amount and a percentage based relative amount, whether it would be whichever is lower there or lower where we have seen that in related party transactions, material related party, 1000 CR or 10% of the consolidated total turnover, right? That is lower. This here for the separate income or expenditure line item, for this is higher. For this, whichever is lower or higher, for when they have given an absolute amount and a relative amount, what they have given is they have given exceeds term, not when it touches, it exceeds. We have discussed in our monetary limits also for these things, these steps to remember the limits. And with that said, we'll just and now we'll move on to our next topic, terms of audit engagement letter. What are all the things that an audit engagement letter shall consist of? What we discussed while discussing essays, audit engagement letter is nothing like any other arrangement that one party will audit the financial statements of the other party. Since both parties were involved, we have to give what responsibilities of both the parties. One party is a management and another party is the auditor. Okay, since audit is not like an investigation, it has a significant, it's had a defined scope, right? And objectives of the auditor. Okay, and we have to define the objectives and the scope of such audit. And with regards to the financial statement, as auditor had went to audit the financial statements were prepared as per a few applicable financial reporting framework. We have to see whether it was, we have to first identify the applicable financial reporting framework, whether the financial statements have been prepared as per AFRF or not. That's another point with regards to what we are going to audit. That's the subject matter and the output of the auditor. Why the auditor is doing audit of financial statements? To give a report. How the report has to be. If it's for banks, he has to give audit report in some other format like LFAR or Ghosh or Jilani committee, and he has to give report on treasury operations, etc., right? And for insurance company and for NBFC, whether they were eligible for registration or not, everything, the formats or the content would change for the audit report. Likewise, we have to see how the format or the content for the audit report has to be. These were the terms of audit engagement letter. And now we'll see our next topic, that is insolvent auditor. Whether an existing auditor in a company had been insolvent or declared as an insolvent, or a normal chartered accountant has declared insolvent, whether he could be appointed or not. We'll just see that it was asked in MTPs, both of the MTPs, and we'll just move on with that. MTP number 1, this is MTP number 1, where under 4C, what they have said, Mr. Seetal, a practicing chartered accountant, due to natural calamities and misfortune in the year 2021, he lost amongst all his wealth and became undischarged insolvent. You see, what are all reasons for he being insolvent? Due to natural calamities and misfortune. Okay. After a few court hearings, finally in 2023, he was declared discharged insolvent and obtained a certificate from the court stating that his insolvency was caused by misfortune without any misconduct. That is, he was insolvent, yes, but due to what are the reasons? Because of his misfortune, not due to misconduct. Okay. You're required to comment on the above situation with reference to CA Act 1949 and the schedules thereof, especially from the point of Section 8, entry name of the registrar members, whether he could be eligible to be a member of the CA register, member of the registers or not, because he was an insolvent, right? Okay, now we'll see how to write the answer for this. First thing we have to, as always said, how to write audit answers with regard to professional ethics. First, we have to identify the clause number. Obviously, it's from entry 8. They have already mentioned. We don't get points for that. If it was given, we'll get 1 mark for that. And writing the correct provision, we'll get another 1 mark. And for if it's given for 5 marks like this, any professional ethics, you have to interrupt in your one words the provision. Why? What the uh, mind behind those provisions that were because of that provisions were being made, and then you'll get 3 marks if it's for 5 marks, and if not, you'll get 2 marks for the 4 marks, and another mark for the copy paste of the question. You have to bring the situation into the answer sheet. You'll get 1 mark for that, and for conclusion, you'll get 1 more mark. Okay, and now we'll see how to write answer for this question. What they have said, they have just mentioned the section number, section 8 of CAAT, and what the section 8 talks about, the circumstances which a person is debarred from having his name under register of members. For this identification, you'll get 1 mark. And for writing provision, if he's being a discharged insolvent, you have to write the provision under this section. If he is a discharged insolvent, he has not obtained from the court, stating that insolvency was caused by misfortune without not any misconduct. In our case, Sheetal had obtained certificate, but when he would be debarred from having his name from the register of members when he had not obtained, that is, he had been insolvent not due to his misfortune, by his misconduct. Okay, when he is insolvent, he got obtained a certificate that he was insolvent because of his misfortune. Then there was no debarration for that. He could have his name on the register of members, and for this you'll get 1 mark. And in addition to that, failure on part of a person to disclose the fact that he suffers from any one of the disabilities which constitute professional misconduct, and the name of the person who is found have been subject to any type of disabilities can be removed from the register of members. Again, the same provisions have been repeated the same way in given case. And copy paste of question, Mr. Sheetal was discharged insolvent, and he had obtained a court certificate stating that insolvency was caused due to misfortune, not misconduct. So he is not violated provisions of section 8. So for this you'll get 4 marks. Okay, and this is how you have to write, and it's a very important question. It was what it had been repeated in both of the MTPs. There's a high chance that this question you would see this in examination. Okay, and I will just move on to our next topic, qualities of the auditor. And here are the qualities that the auditor should possess, which would be calling as fundamental principles of professional ethics. Okay, and what all those qualities? He has to be maintain the integrity, and with regards to the objectivity, he has to be objective, not like a subjective only, or doing audit for only few transactions, or only few sampling. He has to not do or haphazard selection. He has to do a random selection like that. He has to show objective sampling, and has to devote more time on the areas where they were more prone to fraud, like more risk of material misstatements that were happening. And with that said, we'll just move on to the next one, that is professional competence and due care and professional behavior. Make a note, there is no professional skepticism here. Professional skepticism is not a fundamental principle of professional ethics, but the auditor has to maintain professional skepticism throughout the audit. Okay, and a confidentiality has to be given. Confidentiality also has to be maintained, that all the information that he had got attained due to this engagement, he has to not share it with any other third parties. If they had shared, there would be liable, or he would be found guilty under CAAT. Okay, these were the fundamental principles with this regards to the ethics. And with regards to some technical qualities, what all the subject matters he has to have some knowledge about, what are all the other subjects we read in our CA final, they only he has to have knowledge about. For the FR, that is the accounting, he has to know some knowledge with regards to some accounting, and SFM, that is with regards to finance and management. And for audit, obviously, and for law, he has to know some knowledge with regards to the laws and regulations in which the entity's environment was in. And for the taxation, he has to know, have some knowledge. And apart from these, he also have to know knowledge about the client's business. Okay, if it's an mining industry or it's from now oil exploration industry, he has to know some knowledge, uh, basic knowledge, so that he could use some auditor's expert with regards to that, whether the judgments or conclusions were made by him to evaluate those conclusions and all. He has to know some basic knowledge with regards to client's business. And that's it. These were the qualities of the auditor. And now we'll move on with our next topic, that is going concern, which was widely repeated in our MTPs. And we'll just discuss SA 570 going concern very quickly. First of all, while starting the going concern or any other standard, what we have to read, what is our rule? If we read the objectives of the auditors under this, we are half done for the thing. Okay. Here is the objectives of the auditor. Objective of the auditor is to obtain sufficient and appropriate audit evidence regarding the appropriateness of management use of going concern. Okay, what he has to find? He has to find some sufficient and appropriate audit evidence. You see, whenever we find any kind of audit evidence, what are the things that we have to use before? The adjectives: sufficient and appropriate for any data, that is relevant, reliable, and completeness, depending upon the situation. If you don't know any situation, use all the three. That's it. Examiner only will give you, and he will not cut for the extra word that you put. Okay, that's it. These were the keywords that you have to use with regards to that. And to obtain sufficient appropriate audit evidence regarding the appropriateness. Okay, preparing the financial statements was the responsibility of the management. So management has prepared the financial statement on going concern basis. Auditor has to find whether it is appropriate or not. And to conclude, based on the audit evidence obtained, whether a material uncertainty exists related to those events that may cast a significant doubt on the entity's ability to continue as a going concern. This is a hero phrase for the SA 570. You have to remember this. We have for 2 points, whether the going concern was appropriate or not, and second thing, whether there were any material uncertainty exists, whether depending upon the situations or events that had occurred before or after the reporting date, whether would it cast a material uncertainty or not. Okay, and to report as per in accordance with SEA, there have to be also a paragraph in the auditor's report, which we have discussed or seen in detail in this 570 case or 570 SEA, I guess. And these were the objectives. First, if I have to find two objectives, were that first, going concern is appropriate or not. Second thing, there was material uncertainty exist or not with regards to any events or condition that cast a significant doubt on entity's ability to continue as a going concern. Okay, and we'll see the other points also. Under the going concern basis of accounting, the financial statements are prepared under the assumption it's a going concern and will continue its operation for a foreseeable future. What is foreseeable future? For the next accounting term, that is next year. General purpose financial statements are prepared using this going concern basis unless management intends to liquidate the entity or cease its operation or has no realistic alternative but to do so. This is second hero phrase that will be he seeing here, where unless usually financial statements were prepared under going concern concept unless management intends to liquidate or cease operations or there was no realistic alternative but to do so. What are they talking about? No realistic alternative is they cannot do anything other than liquidating or seizing of operations. Okay, if FRF contains an explicit requirement or not, that is, financial statement has to be prepared as per their applicable financial framework, right? Reporting framework. Whether that financial reporting framework contains going concern requirement or not, or management has to assess whether there was a rule in FRF or not, but the management has to assess the going concern thing. And objectives we have seen, and these were the few indicators while evaluating going concern assumption, which we'll discuss it in a while. First, we'll go with the standard. Yes. Okay. What are the factors that are relevant for the management assessment? What we have said, whether FRF explicitly requires or not, management has to assess the going concern assumption or not. what all the factors that are relevant for such as for that assessment, the degree of uncertainty, the size and complexity of the entity, and any judgment about the future is based on information available at that time. That is, that they have judged or made some assumptions and judged about any future event at the time of making of such assessment, whether there have been any changes with regards to that, any uncertainty with regards to any events or conditions, or how well the future events could affect the size and the complexity of the entity, would affect the entity depending upon the size and complexity, and the judgment is based upon the information while doing that assessment. And with regards to some preliminary assessment, if the assessment was made by the management, auditor shall discuss those identified events or conditions which may cast a significant doubt on the entity's ability to continue as a going concern. What we have said, management has to assess whether going concern is applicable or not. So auditor has to discuss whether they had identified any events that would cast a doubt on going concern. And if they have not done the management, if had not done the going concern assessment, and the auditor shall discuss on what basis you have assumed the going concern. If you haven't done any assessment, on what basis you are saying your financial statement eligible to be made under going concern assumption. And if they haven't done, we also have to recommend to do those assessments and all, and auditor shall remain alert throughout the audit. That is professional skepticism for. And management has to identify the events or conditions which would cast a doubt on going concern, right? And if the management has not done, what the auditor has to do, he has to evaluate the management future plans so that it would be undergoing concern assessment. And while doing the entities or prepare the cash flow forecast, right? And you have to also evaluate the reliability of the data, or whether that could be have made under some other, like for window dressing and all. You shouldn't, or you should know the reliability of that data and consider whether any additional facts or information available apart from the time at which the going concern assessment was made. Okay, and request the written representation from management and TCWG with regards to future plans and the feasibility of the projects. And as we have already said, these were the identifying sufficient appropriate audit evidence with regards to events and conditions were the first objective. What the second objective? To draw conclusions derived from that audit evidence. There could be four types of conclusion that the auditor could draw. First, we'll see. First thing, two categories under the conclusions. First thing, the going concern is appropriate or not. Second thing, there exists a material uncertainty or not. First, we'll see adequacy. Okay, wait. First type of disclosure is conclusion. Sorry, first type of conclusion is adequacy of disclosures when events and conditions have been identified and a material uncertainty exists. Okay, they have found some events and conditions which would cast a significant doubt on the going concern assumption, and there exists a material uncertainty. What is material uncertainty? And this we're talking about. You see, they have found few events which would cast doubt on going concern, but there's a material uncertainty existing. That is, it is likely not happening. So that it's a no comes on. If you see negative is obviously a positive. See, negative for a negative one. Okay, so it's like a positive that most likely that the going concern would be appropriate. Okay, what all the auditor has to do? First, you have to identify, you have to deal how the management had dealt with the events and conditions, that is future actions and plans. And second thing, disclose clearly that there a material uncertainty exists. Remember that whenever there is a material uncertainty, you have to disclose that material uncertainty. Okay, a negative condition, events and conditions that cast a doubt on the going concern, but there's a material uncertainty that these events would affect the going concern. So what you have to do, you have to or deal, or you have to just write about the management future plans and disclose that it is a material uncertainty. And what are the second type of conclusion that the auditor could do is the going concern basis is appropriate. Okay, they haven't found any kind of events and conditions, so it's appropriate, but there's a material uncertainty exist. Material uncertainty. So what the auditor has to do forever, for every uncertainty exists, what they have to do, they have to just disclose that material uncertainty. And adequate disclosures which have to be given for the material uncertainty, and he shall express an unmodified opinion, that is a clean report, and auditor shall include a separate section under the heading material uncertainty related to going concern. Okay, they could ask whether the auditor has to report if they'll give this conclusion, the going concern is appropriate, but there's an uncertainty exists, whether the auditor has to modify the report or not. No, he could give clean report, and he has to mention that uncertainty under, you see, this is a positive one, going concern is appropriate is positive, but for a positive there's a negative one. What you have to do, you need not modify the report, but what you have to do, you have to just disclose under a special heading material uncertainty related to going concern, and and if the adequate disclosures of that material uncertainty was not made by the management, then the auditor could give a qualified or adverse opinion. Okay, there's an if condition there. And if the going concern is inappropriate, what he has to do, he has to give an adverse opinion. And if the adequacy of disclosures of the event have been made but no material uncertainty exists, that is, this is a negative one, and here is on no uncertainty, that it would happen that going concern is on a still doubt. So what you have to do, you have to evaluate the requirements of the AFRF. You see, when there is no material uncertainty exists means it is likely that the going concern would be affected. So there were no management future plans, etc., in order to disclose. So what you have to do, you have to just give the requirements as per AFRF, and the financial statements provide adequate disclosures with regards to events and conditions. And that's it. We have completed our 517, and we'll just see the indicators, few financial indicators, operating indicators, and other indicators which were yeah, here it is. Financial indicators were anything that was with regards to the financial statement which was adverse in ratio, like more of debt than for the assets, and more of loss than, and negative cash flows, etc. And we could not able to pay the loans that we have taken, and there have been maturities of long-term loans that have come suddenly on our head, and there was so much of compensations or any kind of claims that also have to be paid by us, and whether we have given guarantees and somebody has defaulted that, and so that we have to pay them, and all these with regards to that, and the investor has withdrew or invested money, etc. These were all the financial indications. We'll see one by one. Net liability of net current liability positions, and fixed term borrowings approach to maturity that we have to pay, an indication of withdrawal of financial support by the creditors, that the creditors were not willing us to give any kind of trade credits, or with regards to any kind of call loans or etc., any kind of loans. And indication that negative operating cash flow, adverse key financial ratios, discontinuance of dividends, arrears of dividends, and inability to pay our creditors at least, and inability to comply with loan agreements, and inability to obtain financing. You see, first creditors were withdrawing the financial support, and we are also not obtaining finance for the new product that we are going to launch. Substantial operating losses, and changes of credit to cash on delivery system. That was, nobody is giving us trade credits also. These were all the financial indications. And with regards to the operating indications, any kinds of management intention to liquidate, a loss of key management without replacement. Okay, there's no leader, there's no captain for the ship. Loss of major market, like what the position of Vodafone or somebody other telecom industry when Jio had launched, right, a free SIM card and all. And labor difficulties, shortage of important supplies, and emergency of high successfully competitor, again a Jio what like example here. And what are the other indications, like non-compliances, pending litigations, changes in laws and regulations, uninsured. And now we'll move on to our next topic, important tax audit clauses. Already we have done how to write audit answer session in Form 3CD, for Form 3CD and professional ethic clauses. If you still, as there were 2 days time, you could watch that. So we have already discussed how to write questions and discussed all the important questions there, and whole Form 3CD. Here, if you don't want to do that, you could just Now you could just continue this session and we will be discussing about the important tax order clauses. You need not remember everything, and all the important clauses have been only those clauses for which ICA asked questions, and out of which ICA hadn't asked any question from check all the past questions. ICA hadn't touched any of the clauses other than these important clauses. Okay, and with regards to the important clauses, first thing, as we have already given the list here down below. Wait a second. Yeah, this was the important clauses list. The PDF was in our Telegram channel, and we'll just see the clauses first. First clause, name of the SEC, and third one is PAN and Aadhaar card that has to be given, and with regards to the state of whether it's a firm or a company or etc. And the previous year, the term of the year of these were all the important clauses in part A. In part B, what they have asked is 11th clause. 11th clause is with regards to books of maintenance, whether the books of accounts prescribed under 44AA. We know that few threshold limits under 44AA, which were detailedly discussed in how to write audit answer session. Now we are just brushing up quickly all the important clauses. You see all the books of accounts, whether they have to be maintained or not. If yes, what all have to be required to maintain as per this section, and what all the books of accounts that have been maintained and the address where it was kept. First thing, whether they have to maintain books as per 44AA. If yes, what are the prescribed books have to be maintained? Two questions in clause A and two questions in clause B. If at all they have said what all the things have to be maintained, what you have maintained. This is required to be maintained books of accounts. This is maintained books of accounts and address where they have been kept. That is 11th. And now we'll see the 13th one. In 13th one, there were first clause A, method of accounting employed in the previous year. What's kind of a mercantile system or cash basis, and whether there have been any change in the method of accounting employed. If so, their financial impact on that. And if answer to B is affirmative, give details of such change, any kind of whether increase in profit or decrease in profit, etc. And D is whether any adjustment is required to be made in P&L account for complying with provisions of ICDs. ICDs have to be complied, right? Whether as there were changes in the accounting system and we have to make any adjustment with regards to ICDs or not. And for such adjustment, the details were given in the next column, in the E column. Okay, what is ICDS 1 accounting policies, whether their impact there on the accounting system to the ICDS, any deviation, whether there was an increase in profit or should be a decrease in profit, and the net effect of that. And ICDS 1 is for the accounting policies, 2 valuation of inventories, 3 is construction contracts. We have to remember this all list. Yes, we have to remember this list. And 4 is what all the important clauses that we are going to discuss. You have to remember those clauses. Okay, you have to remember the number and the clauses and the matter inside that also. Mostly the similar. If you match at least 50% of the terms and all, it would be fine. Okay, you'll get marks. 1 accounting policies, 2 values of inventories, 3 construction contracts, 4th is revenue recognition, 5 is tangible fixed assets, 6 is changes in foreign exchange rates, etc. 7 is government grants, 8 is securities, and 9th one is borrowing cost, and 10th one is provisions, contingent liabilities and contingent assets, and that's it. And any kind of disclosures you have to give, you it would be given here. And we'll see the next one. It is 16th one. Yes, important clauses is 16th one. Amounts that were not credited to the P&L account. You see items that were falling in the scope of 28. What section 28 talks about? It talks about all the credit amounts, all the things, all the matters or items that have to be treated as revenue for the entity. Okay, and what all the things that have been falling under section 28, those, and which should have been credited in P&L account under section 28 of IT Act but have not been credited. One thing, and pro forma credits and duty drawbacks refunds on duties of customs. This under 16b is very, very important. Okay, duty drawbacks and excise or service tax, refunds of sales tax, value added tax. Whether you have to remember all this point, yes, you have to remember all the point. And credits, duty drawbacks, you see it when once you read it 2 to 3 times, it is very easy. Since we have 2 days time, it would be a chance that ICA also could test in so in detail. So just try to just prepare well. Okay, and escalation claims are accepted during the previous year. That was escalation claims was such thing, it was mostly seen in construction or software or developing companies, etc., where a contract amount has been made, a contract for which an agreement has been made, but due to some increase in prices of the raw materials or some undue changes in the agreement, the contract price in the agreement that was already decided could get increased, and those were the explanation claims. And any other item of income and capital receipt, if any, you see capital receipt should not be credited to the profit and loss account, but here we have to just give a disclosure of the capital receipt. Okay, if at all capital receipt have been credited to the profit and loss account, you have to or just add back those capital receipt. Okay, and now we'll see 17th clause, which is a substitution of the old clause, right? In order to boost the real estate sector and all, they have just substituted the reporting requirements of clause 17 for the old one to the new one, where any land or building it is transferred during the previous year for consideration less than the value adopted or assessed or accessible by any authority of state government, refer to section 43 CA 50C. What is difference between 43 CA? When it is the or trade, or it's like a stock for the any kind of business, or it's a business asset, etc. 50C is some capital asset. Okay, this is like stock in trade, and this is a capital asset. Okay, please, what we have to do, we have to give details of that property and consideration that was received or accrued, and value adopted or assessed or accessible, and whether the provision of second proviso of section 43C or section 56, that is the 10% threshold, or the what like threshold limit has been extended to 20% for few years or few months, right, for the residential property and all, that is for the those disclosures. Okay, and with this 17th, they have also given just added a few points with regards to CA here under clause 18, that is particulars with regards to depreciation. And you see the normal disclosures only, description of the asset, rate of depreciation, and actual cost that was written off. Cost of written off means the amount of depreciation. Okay, and what the additional requirements that have been come with regards to the 17th substitution is adjustment that was made to the written down value for the assessment year under 15115 BAC or BAD, where there were few provisions with regard to depreciation, additional depreciation, and all that, right? And adjustment with regards to written down value of intangible assets, excluding the value of goodwill, and adjusted written down value. And additions or deductions during the year with regards to few adjustments like the tax that they have been claimed, or the any change of a rate of the change in currency, whether you have imported any plant of machinery, etc., and with regards to any kind of subsidies or grant that you have got, and depreciation that was allowable as per IT Act, and written down value at the end of the year as per IT Act. And these were general disclosures. And with that said, we'll just move on to the next important clause, that is clause 21. Yes, clause 21 is, please furnish the details about the amounts that were debited to P&L account being in nature of capital, personal, advertisement expenditure. You see, under clause here, right, where it is. Under clause 16, what we have to give? We have to give disclosures with regard to capital receipt which had been not credited. Under clause 21, what we have to give is which we have been debited to the P&L account, any kind of capital expenditure. Okay, there's a quite a similar not okay, very thin difference with regards to that. Please make a note out of it. That's capital receipt which have been not credited, and that is okay, fine, that is fine with regards to only disclosure amount, that's it. And here capital expenditure that have been debited, that is they have violated this. Okay, a thin difference. And what you have to give, the capital expenditure, personal expenditure, and with regards to advertisements, what we have advertisement expenditure in any kind of souvenir, brochure, or pamphlet that was or like published by a political party. There were a few questions with regards to it was all the uh, all the phrase would be the same, and they will be given a trust, or they would be given a cooperative society. Make sure it's a political party. Don't go with the flow. Just I see you test your being calm nature, right? So apart from your what like information that you have or your travel capacity, it also tests your being calm nature. You have to be calm at that situation and give your best. Okay, this is political party. Okay, advertisement expenditure in souvenir, brochure, any kind of pamphlet, etc. And expenditures, there were four types of expenditure incurred at clubs, being entrance fees or subscriptions. Expenditures at clubs being cost for club services and facilities used. This is entrance fees and subscriptions for being a part of member and for using the facilities, this one. And expenditure by way of any penalty or value or kind of any violation of any law, etc. And expenditure by way of penalty that was not covered above. Here, what the difference between these two were, the law which was in force, even though the law was not in force at the time of the at the time of the year or for the financial year, you have done some a violation in the past, and for that you have got penalty here. You have to give disclosures here, okay, which of the law which was not in force, here you have to give disclosure. And expenditure incurred for any purpose which offense have been any offense or prohibited by law, like any kind of fines, etc., that have been incurred for the purpose of any kind of offense, like for any kind of bribes, etc. These things. Okay, what are the things we have to disclose under clause 21? It's an important question. Capital expenditure, personal expenditure, advertisements in any kind of pamphlets, souvenirs, etc., published by a political party, and expenditure for clubs to expenditures, what like by entrance fee or subscriptions or cost of club for the facilities or the services. And next thing is with regards to penalties or fines or for the violation of any law which was being enforced and other than being enforced. Okay, and the fines or penalties or any kind of expenditure that was for the offense prohibited by law. Okay, and clause 21b were amounts inadmissible under 40A as the payments for or non-residents, payment to non-residents with regards to or non-deduction of TDS. 100% amount was or not what ineligible to be detected as an expenditure, right? You have to give details with regards to payment. What all the details you have to give? Okay, for with regards to any payment, what all we have to give? Date of payment, amount of payment, and the parties involved, and the description of that payment, right? The same thing, all the four you have to give: date of payment, amount of that payment, amount of the transaction, and description of that payment, and the parties involved and their addresses. And these all the details with regards to tax that has been deducted but had not been paid during the year, you have to give the same thing, and the amount of the tax extra. And all the payments that were inadmissible under 40A has to be given. You need not remember these in detail, all these twos, and need not be remembered like that. But what you have to remember is these kind of date, amount, nature of payment, and addressee, and for the tax amount, you have to remember these. And that's it. We'll see the clause C1. The amounts debited to profit and loss account being interest, salary, bonus, commission, remuneration inadmissible under 40B or 40BA, where only a particular, only 12% were admissible for the partnership, right? For the capital contribution, for the capital interest, and the remuneration, for which for first 3 lakhs of profits, 1,50,000 or 90% or whichever is higher, and for later on post 3 lakhs it would be just 60% of remuneration. All that inadmissible, all the remuneration that they have taken extra have to be they have to be given here. And disallowance of any kind of deemed income under 40A3. When you receive cash for more than 10,000 as your income, that is disallowed to be in P&L account, right? You have to give that. A serial number is whether if you have invoice, you could do that, or 1, 2, 3, etc. And date of payment. For any transaction, date of payment, and describe that payment and the amount of that amount, and the nature and the person name and the addresses of the parties involved, same as the disclosure which we have seen earlier. And with regards to 40A3A, 40A3 were cash receipts. These were cash payment exceeding the prescribed amount, and E was provision with regards to payment of gratuity that was not allowable. There was a single question with regards to this 40A7, and any sum that was paid by an employer not allowable under section 40A9, and particulars of any contingent liabilities. This was also asked in one question, and the amount of deduction inadmissible under section 40A in respect of the expenditure in relation to the income which do not form part of total income. This is also asked in 2 to 3 questions where the SC had expended few in expenditure on some on pesticides etc. for his agricultural income, and he had expended that in the P&L account. Could he do that? So no, he could not do, because income from agricultural activities were not form part of total income. That's not a taxable income, so he cannot claim expenditure of that pesticides etc. of the agricultural activity. And the questions could be framed that way. And amount inadmissible under proviso of 36(1)(3), that this is about the interest amount, that interest on the borrowings, that borrowing the amount has to be used only for the purpose of business. For the personal loan interest should not be expended in the P&L. It should not be debited to the P&L account. This is with regards to the interest on the borrowed capital. And we'll move with 22nd, that is another important clause with regards to the interest inadmissible under section 23 of MSMEs Act. Of even under the disclosures, we have also seen this interest portion etc. in our Schedule 3 disclosures, right? Schedule 3 disclosures. So make a note out of it, and this is also very important. We'll see 26th clause now in respect of clause section 43B. What they're talking about 43B, what does it mean is few payments, or like payment to the government or leave encashment or something contribution to the employee benefits fund and bonus or commission that was payable to the employees etc., and interest that were paid on the loans and advances that were taken by banks and other parties. These were all the things where you will get deduction only when you make the payment, only when you make the payment before submission of form or like return of income under 139, right, before due date of that. So all the details with regards to that. First thing is, it was very simple. Pre-existed on first day of previous year, that is opening balance, which was not allowed in the previous year because the payment was not made then. If at all they have made payment during the year first one, still it had not made payment, that is even in the pre-existed, that is even the opening due that was there was not paid even in the previous year, that is in the current year, in the financial year for which the tax audit was being prepared, you have to give it in B. And which were incurred in the current year, which were paid. First thing, A was everything was paid before due date etc. Pre-existed paid during the year, which were incurred during the previous year were paid during the year, and B is not paid in the previous year. Okay, these were the things you have to discuss with clause 26. This is an important question. You have to remember all this. It's simple, right? It's simple. So it's simple. And now we'll see 28th clause, where during the previous year the SC had received property being a share of company, not being a company in which public are substantially interested. That it's a unlisted company. What the SSC, the client had received property as a share for in a company where it is unlisted, where public were not substantially interested. Without consideration or for inadequate consideration, you have to give details for that. This is a question where this is why they have to give disclosures is for the shell companies and all. This is what they have to talk about. And with regards to 29th clause, whether during the previous year the SC received any consideration for issue of shares with the exceed of fair market value, thus they're talking about the securities premium. When there exists a securities premium, first of all, the issue price has to be more than the fair market value, and it has to be more than the face value also. Then only you call that difference between the face value and the issue price is the securities premium. And securities premium, you know that it has to be restricted. The purpose to use the securities premium have been restricted to for redemption of any shares of debentures, etc., right? Redemption of debentures, etc. You have to check the purposes of that. And now we'll see 31st clause. 31st clause where it's a last clause, but it could be easily covered here. You see, first, particulars of any loan or advances that were taken under 260 SS, that is like more than 20,000, etc. Right? Now you have to remember two sets for our easy identification. Set A consists of check, bank, draft, and ECS. And the second set consists of account payee check, account payee draft. Okay. And now we'll see the first one. First one, what all the disclosures you have to give? The name, address, the amount of the loan, whether the loan was squared up during the previous year or not. That is, it was taken in the same year and repaid in the same year. And the maximum outstanding amount and the amount that has been taken or accepted by what? Set A, and the amount of the loan that was taken or accepted by set B. And B clause was the same as loan and advances, but it is like a specified sum. What is specified sum? Specified sum is like forfeiture of any kind of advances or any kind of trade advances, etc. It would be under clause B. And with regards to BA, where we are talking about 269 ST, where any kind of a receipt of exceeding that limit was there, and you have to give the description of these transactions and all. And what they're talking about otherwise than set A. Okay, this is, remember, BA is 269 ST, otherwise than set A. And all the disclosures were same with regards to the transactions, the nature of the transaction, date of payment, amount of that receipt, and name and address of the parties involved. Same. BB is again exceeding the receipt of that amount under 269 ST, where that was relating to received by way of set A. Okay, this is otherwise than set A. This is received by set A. Okay. And with regards to the payment of each payment under 269 ST, remember till now we have discussed 2 points. 2 points with regards to 269 ST, that with relation to the receipt, that is otherwise than set A, and otherwise and as per set A, again receipt. And now we are talking about the payment. There comes 2 points with regards to payment and payment here in 269 ST, that is otherwise than set A, and in relation to the made as per set A. Okay, 269 ST payment. Okay, 4 points. Okay, first one, 31A, or the particulars of loan specified sum. We have few disclosures with regards to that. And with regards to 269 ST, first one, receipt, 2 points, that is otherwise than set A and as per set A. Okay, and 2 points with regards to payment under 269 ST, that is otherwise than set A and as per set A, made by a check or bank draft, etc., and not being in set B. Okay, and now we'll see the C point here, where particulars for repayment of loan, that repayment means 269T. And with regards to the repayment, that is the client is repaying, the SC is repaying the loan, whether as per set A or set B, and other amount like maximum outstanding amount and the parties and name, address of the parties, and the amount of repayment that was made. This is with regards to the repayment. And D and E talks about the receipt of the repayment. Okay, it talks about the receipt of the repayment, all the party names and etc. That is otherwise than by set A. D talks about otherwise than set A, that is receipt of the repayment amount, and it talks about E talks about otherwise than set B, that is it had received through check or bank draft other than account payee check or account payee bank draft, that is D. Okay, that is E, and we have completed this, and we'll move on to 35th B. Again, that's an important clause. Here it is. Under 35, all the details with regard to the opening purchases, sales, closing stocks and all. And with regards to the finished products, what you have to give is, you have to give details about the opening stock, purchases made during the year, and the quantity manufactured if it's a manufacturing entity, and sales during the year, and closing stock, and any kind of shortages. There was a question with regards to that, and that's why I have included that. And With regards to 39, 40, these were also important, but not much. And with regards to 41, 42, and 44, there were three clauses left. And details with regards to demand that was raised or refund that was issued during the previous year. And other than the tax laws and wealth tax, along with the relevant details of the proceeding. That was details with regards to demand raised or refund issued. Two key points under clause 41. And now we'll see 42, whether SC had required to furnish form 61, 61A and 61B, whether he has to do that like SFTs, etc. and those points. And if yes, all the details with regards to that, like due date, furnishing, type of the form, like whether it's 61, 61A or 61B, and date of furnishing that, and income tax reporting identification number, etc. This is mostly asked, this is, you have to write it mostly when the entity has to file SFT transactions, SFT report. Okay, and now we'll see 44th clause. Although there were no questions that were asked, but this was a amendment that had been a new clause that was introduced in this accounting year, in this tax period, with regards to the breakup of total expenditure, whether you are registered or not registered under GST. First thing, there were two categories where expenditure with respect to the entities under GST and expenditure with regards to not under GST. And under GST, this is the total expenditure during the year. And you have made purchases from GST registered entities with regards to any goods that you have bought which were exempt from GST from those GST registered one. And with regards to any kind of composition scheme, or you have bought any kind of goods from composition dealers and from other registered entities, and this is a sum of all this and total payment that was made to the registered entities. And this amount is the difference between this portion and this one. And that's it. We have completed all the important clauses in Form 3CD. And we'll just move on to our next topic, that is components of CFS. And now we'll see all the areas or important areas in audit of CFS, not only the components. What are the components of CFS? It includes a consolidated balance sheet, a consolidated profit and loss account, and a consolidated cash flow statement. And if it's applicable, and if that is the company is doing in days, then consolidated statement of change in equity, and any explanatory notes, which is normally a part of the financial statement, notes to accounts. Okay, balance sheet, profit and loss account, cash flow, and consolidated change of equity, and explanatory notes. These were all the components of CFS. And we'll just quickly wrap up few important areas in audit of CFS also. CFS is mandatory for companies. For what all companies? When a company is having one or more subsidiaries, including any kind of joint ventures and associates, you have to consolidate that. You see, as per section 129, it gives provisions with regards to CFS, what all the provisions under which CFS has to be done. And CFS has to be approved by the board before they sign that. And the company shall attach with its financial statements a separate statement containing the features of the subsidiaries financial statements in form AOC 1. And CFS shall be in accordance with Schedule 3 and the applicable accounting standards and all. And what all the companies for which CFS is not applicable, they need not do CFS. First of all, that company should be a wholly subsidiary company or a partially owned subsidiary. Any company which should be a subsidiary company, it should not be the ultimate parent company. Okay, when it's a subsidiary and all its members, whether they have right to vote or they do not have right to vote, give in writing that what they have to write. They do not object the company not present in the financial statements. Okay, but when the company should be subsidiary, first condition. Second condition is when all members, whether they have right to vote or do not have right to vote in a general meeting, they have to give in writing a letter. What that letter should tell, that the letter should contain that they do not object. Who do not object? The members do not object the company in not presenting the CFS. That's one thing. And that is an and, not an or. Okay, and it's a company whose securities were not listed. It should be an unlisted company, okay? And say whether in India or outside India, and it is ultimate or intermediary holding company files CFS. Okay, since it's a subsidiary, its ultimate holding company or an intermediate holding company shall file CFS with the registrar and is in compliance with accounting standard. These were all the three conditions should be satisfied. Okay. Plus, if it's an investing entity, they need not consolidate, because it they go with fair value measurement and P&L, right? How do we call it as an investment entity? When it obtains funds from one or more investors for the purpose of investing and invest management services for the purpose of investing in various entities. Okay, and second thing, it commits to the investors that its business purpose is to invest funds solely for returns and from capital appreciation. And the third thing is measures and evaluate the performance of substantially all the investment on the fair value basis. Okay, when these three conditions were satisfied, they raise fund from one or more investors, and the business purpose is solely from returns of capital appreciation and investment income, whether it could be an what like interest or dividend, any kind of interest, any kind of investment income. And third thing is that they measure and evaluate the investments on fair value basis. Okay, and these were with regards to that, and we'll see the responsibility of the parent now. Like they have to identify the components here. What they're talking about is the branch or the subsidiary, or whether kind of associate or joint venture, etc. All these were consolidated together and called as a component. First they have to identify the component, and whether they were reportable segment, or they have found any kind of segments with regards to segmental reporting, and identify all the related party transactions, and they have to obtain accurate and complete financial information from the components. This is accurate and complete information from the components. They are using adjectives for the financial information, and make appropriate consolidated adjustment, and they have to harmonize the accounting policies for when you're consolidating one or more entities. You have to harmonize the accounting policies of different entities as of to the parent entity, and gap conversion whenever it's applicable. These were the responsibilities of the parent. You have to identify, you have to check whether the information was accurate or complete, and then segment reporting and related party transaction, consolidated adjustments, harmonization of accounting policies, and gap conversion. These were the responsibilities of the parent entity. And now we'll see what like another thing was special considerations with regards to CFS. What all the special considerations have to be taken? Well, there were two kinds of adjustments: permanent consolidated adjustments and current period consolidated adjustments. Permanent period consolidated adjustments were done when you newly add an entity, when there was a change in the of only you do it only for one time. Okay, and what are those adjustments? We'll see adjustments that are made on the first occasion or subsequent occasion which there was a change in the shareholding, etc. And there are determination of goodwill, capital reserve. You see, this is when we this when we find out when we first acquire the subsidiary or subsidiary, right? And determination of the amount of equity or minority interest or non-controlling interest. Okay, these were the permanent adjustment. And what are current period adjustments? Were adjustments that are made in every accounting period whenever the CFS were done, and these related to elimination of intra-group transactions and accounting balances, such as when you have a given loan, when you have been both debtors and creditors in the thing, you have to net off those, right? You have to, that is what they're talking about, the current period adjustment. And now we'll see in detail what are current period adjustments. This could be widely asked as a direct question. It had been repeated as a direct question, MCQs and case scenario also. It's an important point for this audit of CFS. First, we'll see what are current period adjustments. There were intergroup interest paid or interest received. That is relating to intragroup indebtedness. But one with regards to indebtedness, And second, with regards to unrealized intra-group profits, that is any assets acquired or assets have been transferred for that. Like not only assets, even the stock, sales or purchases, any kind of assets, stock in trade also included. And third thing is record deferred taxes on unrealized intercompany profits elimination. That is, these two were interlinked. First thing, unrealized intergroup profits, and record deferred taxes on unrealized intercompany profits, etc. And adjustments relating to harmonizing of accounting policies, which we have also seen, where under the responsibilities of the parent entity, right? And the adjustments to the financial statement for recognized subsequent events or transaction that occur between balance sheet date and date of the auditor's report. These were with subsequent events, which we'll discuss in a while. What all the current period adjustment? One with regards to the indebtedness, that is interest. Second thing, when transfer of assets, that is intra-group profits. And third thing is in relation to both, that is deferred tax on unrealized intercompany profits. And fourth one is harmonizing. Again, go back to the responsibilities of parent entity, that is harmonizing of accounting policies and subsequent events, which we will discuss subsequently. These were the subsequent events. As we know, there were two types of subsequent events. One is adjusting event. Second thing is non-adjusting event. Adjusting events, we have to adjust the amounts in the financial statements. For the non-adjusting events, we have to just give a disclosure. When we call an event an adjusting event, when the events that had occurred after the reporting period, but there exist few conditions that were already present on the date of date of reporting, that is before the year only, in the previous year only. You see, events or transaction that provide an evidence about conditions that existed at the date of financial statement. Might be the outcome had come after the reporting date, but that event evidence was already, that had been started, that event has been started prior the period only, prior date of reporting only. And if it did not exist an evidence for that, it had arose, those events had arose after that date of reporting, then those were all non-adjusting events. Okay, and these were with regards to that. And we'll see the reporting requirements now. Yes. What all the reporting requirements under CFS? What all they have to report? Where the parent auditor is also the auditor of all its components. That is the same auditor for the parent company and the holding company. Then how he has to report? He has to report that he has to issue a report expressing an opinion that he has issued a true or fair view on the states of affairs of the group. That is a consolidated group. Okay. And if the parent company auditor is not the auditor of its components, then what he has to do? He has to just disclose the fact that he had used the work of the other auditors and they had an indication of divided responsibility for between the auditors for the parent and its subsidiaries. And with regards to the next topic is when the components of the auditor report on the financial statements under a accounting framework different from that of the parent. That is the accounting framework, the applicable financial reporting framework for the subsidiary and the parent were different. What the management has to do, management has to harmonize the accounting policies. What the auditor has to do, he has to audit the conversion adjustments, and has to give the report based upon that. Okay. And when the components auditor, that is some subsidiaries auditor or any kind of associate auditors, had given audit report under different kind of auditing framework, then what the parent auditor has to do? What he has to do is has to give report of audit report under GAS, that is generally accepted auditing standards. Okay. And when the components were not audited, you have to just give the list of the components which have been not audited and reasons thereof. And that's it. We have completed our component of CFS, and now we'll just move on to government company applicability. And what is the definition of government entity? A company where the paid up share capital is more than or equal to 51%, that is at least 51%, not 50.5%. It is at least 51% of paid up share capital was held by central government, state government, or in a combination of both, and also a subsidiary of a government company. It need not be a wholly owned subsidiary. normal subsidiary, more than 51% of the subsidiary of more than 50% of the entity would be regarded as a subsidiary, right? Or having a control like board of directors or majority of the board of directors or at least one of the executive directors, right? Or then it's a subsidiary company, and that subsidiary company whose parent company is a government company would also be a deemed government company. This is the definition of the government company. And now we'll see articles under the constitution which prescribe the role of CNDG. Why we have to check for CNDG? CNDG is the one who appoints auditor for the government company, right? And that's why. And these were what? These were mostly used in MCQs. Under Article 148, appointment of CNDG was done, and CNDG was appointed by President. And under Article 149, what all the duties and the powers he has would be prescribed there. Under Article 150, on advice of CNDG, President to prescribe the form of the accounts of union and state shall be kept. That is, President prescribes the form in which accounts has to be given by the unions or the states and with the advice of CNDG. Okay, that's a special recommendations by CNDG. And Article 151, audit reports of the CNDG relating to the accounts of the state government or central government should be submitted to the president or governor. Why president? Because he's the only one appointed, right? That one. And for the state, has to submit to the governor of that state and have to be led before the parliament for the state central, sorry, parliament for the central and the state legislative assembly for the state. And now we'll see what are the kinds of organization subject to the audit of CNDG. What are the kinds of things that would come? What, like union and state government departments and all the public commercial enterprises or non-commercial autonomous bodies also would come under, and authorities and bodies substantially financed by union or state revenues. And see, what does the union or state government means? They were like a backward welfare department, well, and like a higher education department. All those comes under here. And while coming to the public commercial enterprises like Indian Oil Corporation or State Bank of India, and while coming to the non-commercial autonomous bodies like Indian Diamond Institute or Indian International, Institute of foreign trade, etc. And with regards to the authorities and bodies that were substantially financed by government, were you say it like government mints, where the government mint the paper currency or the coins, and where the income tax settlement commission and all these were all bodies, general bodies. For these, the CNDG does the audit. And now we'll see uh, with regards to the parliament or the president have segregated these activities of these several bodies into three kinds of committees. What are those? For seeing the welfare of the accounts and all, they have established public accounts committee. And for the estimates and all, while the February 1st will give the budgets, right, that it was foreseeing the deficit budget of this 1,000 crores, and there have been at a surplus of these 1,000 crores that was estimated by the estimates committee. And the committee on public undertakings, like what like acquiring a few banks and all, and acquiring all the government companies, etc., right? The merging of those, like that. And these three are main committees with regards to the government bodies. First we'll see public accounts committee. These could be asked as a direct question, so better you prepare those for the three committees. These were really important. What's the duty of the PACs? Was what do? They actually do the accounts thing, right? What like accounts means the disbursements of the any kind of grants that they have, or whether the expenditure had been made correctly or not, whether they have authorization or not. Okay, we have to see the same thing, whether monies were dispersed legally on the service for that purpose or not, and the expenditure incurred was authorized or not, whether there was proper authorization or not, and reappropriation has been made as per the laid down provisions or not. And while coming to the estimates committee, as we have said, estimate committee mostly will see that in a forthcoming year, what are the, whether we have a deficit budget or a surplus budget, it was all maintained by this. These were more a form of like projections, okay? And these have nothing to do with the accounts and all, but they have what, like they have something with regards to the non-financial information, how the decisions were, and how what are the future actions of that government entity, etc. So they have more concern over that, how efficient the works were, and how economy, how whether economic was like using the minimum cost to get the desired result, and efficiency is getting the desired result, right? Those two things we have to the estimates committee check. And alternative policies, whether we have to change the policies, etc. With regards to, since we have a deficit budget, whether they could advise to change policies with regards to that, and examine whether the money will be laid down within the limit or not. That is that talking about the money limits and all. And such is a form for the estimates, as we have said. C&AG advises the president, or president actually gives the form in which accounts have to be maintained and the audit report, etc. But for the estimates, it had nothing to do with the accounts and estimate, accounts and the audit report. It gives, it advises its own format. Estimates committee, make a note over there. And the committee on the public undertakings, as we have already discussed, it's more like what all the companies or what all the things have to be merged together, or what all. Now we'll see in detail committee of public undertakings. What that deals with exercising the same financial control on the public sector undertaking as PAC does over the functioning of the government departments. The functions of these committee are to examine the reports and accounts of public undertakings, examine reports of CNDG on public undertakings, and to examine the autonomy and efficiency of public undertaking, and to see whether they are being managed in accordance with sound business principles or not, and to exercise other functions. You see, it is it is reviewing and it is examining all the duties that were performed by all the above committees, right? It's examining the reports and accounts that were submitted to the PAC, and it was examining the reports that were given by the CNDG, and it is also examining the efficiency of the public undertakings and sound business principles and all. This was mostly was seen by the estimates committee. So it examines all these things and considers which all has to be measured, which all has to be merged, or which all the businesses we have to take control on. Okay. And with that said, we'll see some CNDG rules, a role of CNDG. And he is Girish Chandra Murmu, who is CNDG or present CNDG. And what he has to do? He has to give reports on basis of the committees working. We have 3 committees, right? Those he have to give report on. He has to scrutinize the notes which ministries submit to those committees. Okay, what all ministries? Like we have different kind of ministries with regards to Ministry of Corporate Affairs and Ministry for the Defense, etc. All these kind of ministries, and the finance committees present their report to the Parliament and state legislature with their observations and recommendations. And it gives some recommendations. What the recommendation have to be done? It has to make them present into the action. They have to follow those and follow and present the action taken reports to the Parliament and the legislature. And in respect of the audit reports, what they have to do? They have to be discussed in detail with the committees, etc. And they have to not take that lightly by the government. And these are with regards to that. And now we'll see what all the steps that were involved in the government company audit. First of all, in order to make any audit, first what do we have to? We have to appoint the auditor. Who appoints? C&AG appoints the auditor. Okay, and after that, all the time limits and all that. If C&AG do not appoint within so many days, a company could appoint and shareholders could appoint, right? That all we have discussed in the time limits of time limits PDF or time limits video. If you haven't watched, do the check that out. Since we have 2 days, it is very. I'm just recommending you to watch the time limits, monetary limits, and board limits videos. It would be very helpful for you, where we are putting all the time limits and monetary limits all together in one area, so that it would be very nice for us to revise all in one place. Okay, and that's it. After appointment, what he has to give? He has to give audit report. To whom he has to give? To who had appointed him? Only he has to submit the audit report to them, like C&AG. Here C&AG, what C&AG could do? He could also audit, or he could also require supplementary audit for the audit that was done above. Okay, within how many days? Within 60 days. This was also a power of C&AG, you could also call that. And C&AG, what all he could do? He could comment upon or supplement such audit report. He could comment upon the audit report, or he could supplement that audit report, like adding few more pages or adding few more things to the audit report that was already submitted. This is also again a right of the CNDG. And the third right is test audit. He could Test audit was a difference between supplementary audit and test audit. Supplementary audit is in continuance to the audit. Test audit is testing somewhere in between a few accounts, or testing only sales, or testing only grants that were received, etc., or testing only the expenditures on the loan, or only with regards to only particular appropriation of the grant, etc. These were known as test audit. He could also do test audit. And that's what with regards to the steps of government audit. And and now we'll see what all kinds of audits that we uh, could do for the government audit, like if depends upon the subject matter. See, if you're auditing the financial statements, it would be called as financial audit. It is mostly conducted for expressing of open opinion on the financial statements and enhance the degree of confidence for the intended users of the financial statements. And that's with regards to the financial audit. If you remember these two things, that is far more than enough. And for the compliance audit, as by its name, they have to comply with few rules and regulations. What are those rules and regulations? There were two types of that regulatories. With regards to regulatory, some regulatory authorities had put some rules and regulation, what we call as laws and regulations, right? Agreements, etc. They have to comply with those. Who has to comply? The government company, or the four bodies we have seen, right? Those, they have to comply with the laws and regulation. And second thing, what they have to comply, they have to comply the proprietary. What are they doing? They're doing business. What they have to comply with? They have to comply with the general principles of governing sound financial management and ethical conduct of public officials. You see, what first thing they have, they are doing business. Nobody does business for loss, right? We have seen this somewhere, who have to check for the whether they were doing business as per sound business principles or not. We have seen in committees of public undertakings, right? I think that's a third or fourth point there. Yes, they have to also comply with the sound business principles, like sound financial management and ethical conduct of the public officials, like they have to not take bribe, etc., and they have to attend, etc., they have to attend the office regularly, and all these were like code of ethics. You think it as a code of ethics. Ethics for business is something that was doing business for profit, and for ethical conduct of the public financial officials. And this is with regards to the compliance audit. And usually compliance audit was done along with the audit of financial statements, or it was done separately, or combination with performance auditing. What is performance auditing? As same thing, you have seen it in SEMP, right? Efficiency, effectiveness, etc., right? And economy, all the same thing. Economy is minimizing the cost for the desired result. For the you have to minimize the cost of resources for the activity. And this is also, the performance was overviewed by the committee of public undertakings. Okay. And with regards to the economy, efficiency is they're working efficient, labor efficiency. They're working so much so that that they get the desired result. And with regards to the effectiveness is the policies and procedures, like a relationship between the intended impact and the actual impact of an activity, the whether this policy was effective or not, whether this rule is effective or not. And now we'll see performance audit in detail. It is actually, this is the definition of performance audit. You see, for the financial audit and compliance audit, you have to remember these 3 points, or these things, right? For the performance audit also, you have to remember this definition plus their objectives. If you remember objectives of any kind of audit or any kind of standards, you're halfway done for that. And a performance audit is an objective and systematic examination of evidence for the purpose of providing an independent assessment of the performance of government organization. It is an examination of, it is an independent assessment of performance of government organization or program or activity or function, anything, to improve public accountability. Their objective is to improve the public accountability and facilitate decision making by the parties with responsibility to oversee or initiate corrective action. Okay. And we'll see what all this it has to examine. It has to examine whether the decisions by the legislature are efficiently and effectively prepared and implemented. We have to check how they were performing in the government organization, whether they were effective and they were efficient. Effective with regards to the whether you are effectively putting that rule or regulation into the business and efficiently working. The persons who were implementing that were efficiently working to do to make that rule effectively work. Are you understanding this? You have to work so efficient to make that rule so effective. Okay, make that regulation effective in a more economic way with a minimal cost. This is a circle. Okay, and taxpayers or citizens are received value for money, that is to improve public accountability, etc. And that's it. And we'll see what is economy. It is minimizing the cost for the best price, etc. And efficiency is input output ratio for the you have to get the maximum output for the maximum kind of effort, etc. You have to give best. And effectiveness is the objectives were achieved or not. And you need not read everything these in detail, they don't ask in detail such. And with that said, we have completed our what like performance audit. And these were sources of understanding the entity and all. You could write what all you remember from any standards on auditing. Everything was the same. We are doing audit for everything. But what you have to do, what you have to prepare so much for a specific audit is only the specific points, not in general like this. You see, source of entities, not you need not remember these things separately. You could write it from the standards. Okay. And now we'll see comprehensive audit. What is comprehensive audit is, it is like an extra audit after all the audits have done. When we find any kind of weaknesses, etc., right? When something wrong that's going to happen, etc. All these have to be covered in this comprehensive audit. C&AG with assist the legislature in reviewing the performance of the public undertakings. And he conducts a efficiency cum performance audit on areas that was other than covered by the internal auditor, etc. They have found some weaknesses, etc. Where he locates the area of weakness or extravagance of management information. What is extravagance means spending of so much amount. Okay, and there's a weakness there, and they have been spent so much of what like amount that was, or the grants that they have taken, and those areas that were covered under comprehensive audit. What we'll see the examples of those some issues of the comprehensive audit. What are those extravagant situations or weakness situations were, and how does the overall capital cost of the project compare to the approved planned cost. And you see, as we have said, there's a weakness with regards to some internal controls, and they have spent a lot of money. So all these issues will cover maximum with regards to only those, like spending so much of money. We have to check the difference between the planned money for that purpose and the actual amount of the money spent on that project, etc. We have to check mostly similarly uh, like this. You see, first topic is overall capital cost for that project to the approved planned cost. There's a difference between, there was a substantial increase in the cost, capital cost for the that one already planned, and the planned production to the outputs that have been achieved, and why they have underutilization of the installed capacity. That is a weakness in the actions or the acts that the company do, and extravagant, that is spending mostly the amount on some matters. So these two things were mostly discussed. And here planned rate of return has been achieved, and whether the systems of the project formulation execution sound means whether as per sound business principle, whether the actions that were taken, the investments that were made in the projects were to earn profits or not. Government has to run business not for loss making. Anybody has to do business if it, unless it is a non-commercial entity. Non-commercial entities also do business only for the profit. Nobody does business for making losses, right? Okay. Well, we have to check whether they were sound or not, and we have to check the cost control measures as they have been extravagant, that is, they're spending so much whether we have to check any cost control measures that were adequate or not, and why they were inefficiencies or wastage in raw materials. Wastage in raw materials was again a weakness in controls, and purchase policies were adequate or not. And we have to see whether the procedures were effective and economical. Why economical was done here? Because economical was use of minimum resources with lower cost achieve the desired result. And you need not remember everything. Remember 4 to 5 points. Once go through all the things of which you get more connected to, or just replace that, or remember only those 4 to 5 points. That would be more than enough. As we get only 4 to 5 mark questions right, it would be more than enough for that. Or remember maximum to 6 points. And with that said, we will just see the proprietary audit. What does proprietary audit means? Proprietary means, again, as we have said, sound business. Business has to be done for earning profit, not to make losses. We have to check whether the business was done as per the actual rules and regulations, etc. We'll see the definition of the proprietary audit first. What does proprietary audit means? Whether it meets the tests of public interest, commonly acceptable customs and standards of conduct, and particularly applied to professional performance and requirements of law, government regulations, or professional codes, which usually a business follows. Okay, these were the proprietary. You need not remember this definition. What you have to remember is you have to remember this principles of the proprietary audit. What are those? What are the principles? For the expenditure is not prima facie more than the occasion's demand. That is, you have to not expend on the occasion which what usually it requires. Okay, that is rule 1 of business. And rule 2 is that the authority exercise power of sanctioning expenditure has to pass order which will not directly or indirectly accrue to its own advantage. That is, the authority who authorizes an expenditure, etc., has to not make good for himself. That is, with regards to the expenditure. This is the quantity of expenditure, and with regards to the advantage, the final beneficiary should be the business, but not the authority who is passing or sanctioning the expenditure. That's the quality of that expenditure. Okay. And third one is the funds are not utilized for the benefit of particular person. Here the funds were not utilized for the own advantage of the authority sanctioning that, or the second again. And similar to that, the funds were not utilized for the benefit of a particular person or a group of persons. And apart from the agreed remuneration or reward or any other incentive, etc., or kept open to indirect benefit of the management personnel or employees or others. What they're talking about is the remuneration or a part of remuneration shall not be kept open for the management or personnel or employees. That is, they have to not take more than what the agreed remuneration or agreed incentives. Okay, these were with regards to the proprietary audit, and we have completed our government audit here. And we'll move to the next topic. Yes, we have completed steps in government audit, and we have seen performance audit, and now we'll go with due diligence. What is the definition of due diligence? Due diligence refers to an examination of potential investment to confirm all material facts of the prospective business opportunity. It involves review of financial and non-financial records as deemed relevant and material. Okay, who does the due diligence? A prospective investor. For the prospective investment of the business or any kind of business he wanted to do investment, he'll do due diligence for that. And whether he or to find out whether it's a potential investment or not. Potential investment is whether the money that was invested in the like any kind of business could able to gain him so much or gain him the profits or the shares, etc., whether it's a potential investment or not, whether it could render his returns or not. And what are the main reasons for carrying out due diligence? Was to confirm that the business is what it appears to be. You see, the founders of this investment or the founders of the business or the startups, they claim a lot of the due diligence has to be done whether to confirm that the business is how it is appears to be, or whether there have been any window dressing for the sales amount or the market acquisition, etc., or market share, whether it was true or not. We have to confirm that to identify. Think of like a Shark Tank. the one who had running the business have come for the sharks to invest, right? And think like that. These were the when they come and talk about the product and the revenue it had generated and the market share it had, whether it is we have to confirm whether that was true or not. Second thing, to identify potential deal killer defects in the target and avoid a bad business transaction. That is, to avoid any kind of you have to what's the main objective of due diligence is to find the potential investment. So to find potential investment, you also have to find the negative things. That's a deal killer. That is something you're gonna fall for it, right? You might dump all the money on in vain for a business which would not stand by, or whether it's a shell company, etc. Okay, and to gain information that will be useful for valuing assets, defining the representations and warranties, and renegotiating and price concessions, or to gain information with regards to the valuation of assets of the entity, and to what like renegotiate the price at which the entity or the share has to be acquired in that entity, and to verify the transaction complies with the investment and acquisition criteria, that whether that investment in that particular entity could give the return that was desired by the investor or not. And classification of due diligence, what are the types of due diligence? It's a commercial and operational due diligence, which is concerned with regards to evaluation of commercial, strategic, and operational perspective. And with regards to financial due diligence, it does analyze the books of accounts and other financial information. Tax due diligence is with regards to all the tax related matters. It was mostly done where the regulatories were more, like with regards to the export house, if you have been trying to invest in an export house, and even with regards to the banks also, orchard funds, etc. There has so much of regularities there, right? You have to do tax audit while acquiring that entity, and legal due diligence to talk to know about any kind of claims that have been made, or the compensation that one has to pay for the courts, etc., where the litigations mostly it was done under construction based, etc., construction companies. And with regards to the environmental due diligence, it was mostly widely used in the chemical industries, whether any potential environmental cost for the cost of disposal, etc., or environmental cost, which we have already read a lot of times in SMP. Yeah, and personal due diligence is with regards to the employees and employee policies, etc., whether the gratuity that they're having, etc. And there's more detail with regards to financial due diligence, is that first you have to see the brief description of the business. And for any kind of business, what you'll see the description or history of the business, how well it was rooted, and the background of the promoters and the persons behind them. And because it's a financial due diligence, what comes? Financial statements comes, how they will be prepared. It's prepared under accounting policies and practices, and management information systems, and the details of the management structure with regards to the management and trading results, both past and present, whether they were on a loss making or profit making, and what are their forthcoming projects, etc. And with regard to the balance sheet, this is for the P&L account, and this for the balance sheet. You see, history of the business, and with regards to promoters, one category. Because it's a financial due diligence, you have to talk so much about the financial statements, the accounting policies and practices, and with regards to the P&L account, the trading results, and for the balance sheet, the assets and liabilities. And with regards to the management, we have talked about the promoters, so we have to talk about the management also, the management information system, and the details of the management structure, what the hierarchy of the management or board of directors, and the current status of the income tax assessments and cash flow patterns. And obviously the P&L had come, balance sheet had come, and there has to come a cash flow statement also. In cash flow statement, what do we have? We are projecting the future profitability also. Even the projections also had come. Just remember in a category wise, so that it will be very helpful, so that you're forming a chain, or you're like your there's a continuity like a blockchain. There's a continuity for every point, so that nothing breaks. Okay, and with regards to the financial due diligence, what are the main objective? First thing, were there any hidden liabilities? Okay, what comes here is first objective for the due diligence is to confirm whether the business is what it appears to be. You see that or what like the promoters had given or the management have prepared financial statement with few assets and liabilities, or they have talked so much about profits, etc. Right? We have to check whether they were true as per that or not. So for the balance sheet things, the most important thing is we have to see two things which would avoid us from a deal killer or a bad business transaction. That is any hidden liabilities. That liabilities were there, existed, but they were not brought into financial statements. Second thing is overvalued assets. Assets were there, but they were overvalued for window dressing. First thing, you have to check mostly these two things. It was widely repeated, and you have to just remember all this. And don't worry if you, while writing the points of hidden liabilities and overvalued assets, you have to make sure you have a picture of some balance sheets and P&L statements there. We have to just walk through those process of the operations in the business, and just we could easily write. Okay, first thing, with regards to hidden liabilities, the company may not show any show cause notices which have not turned into demands. That they were contingent liabilities. We have to check for the show cause notices which haven't matured as demands. And second thing, whether the company had given any letter of comforts. What a letter of comforts? Say it is like any other in subsidiary, it's subsidiaries or taking a loan or etc. The company, the holding company, that the company which is undergoing the due diligence could give letter of comfort. What it is about the financial stability of that entity. It guarantees the financial stability of the subsidiary for the loan that was taking, etc. It is not a guarantee. Guarantee has a letter of guarantee or bank guarantees, or they have like a legal responsibility. But while coming to the letter of comfort, they have some moral responsibility to fulfill. If they have just if the subsidiary had not paid the amount it could not able to pay, this holding company, the company under which due diligence was going to take place, they have to pay. Otherwise, they would have some. There would be a loss in the business reputation, etc., and a bad adverse media publicity, etc. That's what the letter of comforts we have to check for, and we have to check the company may have sold some subsidiaries or businesses which may agree to take over all liabilities or contingent liabilities, and they may not be reflected in the books of accounts. So whether there were any kind of a change in ownership, the subsidiaries had agreed to take over few assets or few liabilities, and we have to see all those liabilities, etc., which the company had agreed to take on for the a company that it had acquired. And the product and other liability claims, and we have some tax liabilities and pending sales tax liabilities and pending final assessment of custom duties, all with related to the tax and agreement to the buyback of shares sold at a stated price. What does that mean? Your a buyback, when a company buybacks any kind of shares, usually it buybacks at a price that is higher than the market price, usually, in order to encourage the buyback. So we have to, since it's also a liability, right? If it had bought from the open market, it would have been a lower rate. We have to also check the stated price, etc., and future lease liabilities and any kind of environmental claims, unfunded gratuity, and huge labor claims. All that with regards to employees, environment, tax, and something with regards to the courts also. Courts, and with regards to banks. For the banks, it is letter of comforts. For the courts, it is show cause notice or any kind of tax regulatory authorities. And with regards to tax liabilities and sales tax, custom duties, and with regards to public at a large, it is buyback of shares. And for the environment, environmental claims, and for the employees, it is gratuity or labor claims. Yes, you have to remember almost 7 to 8 of the points, which would be far more than enough, and you could easily write up. And while talking about the overvalued assets, there were uncollected or uncollectible receivables. That is, they were obsolete. You cannot, what like for an this is not a bank to treat that as an NPA, but the receivables which are trade receivables, etc., which we also have columns, right? like for more than 2 years, 2 to 3 years. Why were there so long, all the trade receivables, etc.? So whether we could collect that or not collect, we have to check that whether the trade receivable had been absconded, etc. We have to check all that. And there were inventory in the, we'll go with from current assets, right? We have seen trade receivables here, and now we'll see the stock in trade, whether it was obsolete or not moving, and their NRV is very low with compared to the amount that was in the balance sheet. And with regards to the non-current assets, the plant and machinery was obsolete or underused, and assets that were carried at more than the current market value, and the litigated assets and investments were carried at cost whose net realizable value is lower. You see, for the stock and some assets and investment, these 3 points comes under the same category, that they have been carried at a higher rate in the balance sheet, higher value, higher amount in the balance sheet than that of their original NRVs or market values, or any other their current market value. So one, if you remember 1 point, you could write three: one for stocks, assets, and investments. And investments which were carrying very lower rate of return, lower rate of return, and infructuous project expenditure, that was uh, you have spent it unnecessarily, you have spent it unnecessarily, the huge lots of project and that expenditure, intangible assets that having no value. And with regards to that, company balance is under reconciliation. Okay, they were so simple. With regards to the current liability, current assets and non-current assets, current assets for the trade receivables, for the stock, when you remember the stock, you have to remember the key objective there. That is, they're having carried at a value higher than that of the values. So that for the stock, you have to also write the assets and the investment here. For the investments, having low return. Again linking. When you link the points together, it is very hard for you not to remember. Okay. So there is a low chance for you forgetting that when you link the points, okay? When the investments of a low rate of written. And now we'll see the work approach of the due diligence. That is the steps in the due diligence, how the due diligence would take place. First, you have to review the documents. First, what you do, review the report, the financials that were submitted by the target company. That is the company which is undergoing due diligence. And second thing is, if possible, go and assess the business internal controls, etc., in first hand through by a site visit. Okay, and what you have to do, you have to work through the business or due diligence process with the acquisition company or investor for defining the key areas, what the investor is mostly looking into forward, whether he's looking into only for the revenue or profit sharing percentage, or he wanted to be a part of manager a key managerial person or a board of directors, what kind of things he wanted to do, whether he wanted the more like patents, etc. Depending upon it, it varies from investor to investor for a business, right? We have to also do the due diligence process with respect to the key areas that were defined by the acquisition company or the investor, and help preparing an offer letter after completion of due diligence. And this is how a due diligence report was. Like you have some executive summary, introduction, background, objective of the due diligence, and terms, history, shareholding pattern, and assessment of management structure and all. You have some deja vu of reading the same things, right? We have seen it here, right? Objectives of a due diligence process. And now we'll move on to next topic, investigation. Now we'll see the difference between investigation and audit. Objective. What is the objective of investigation is? Investigation aims at establishing the fact or happening, assessing a particular situation. Mostly investigation is done when we come to know that the fraud had happened in the entity. So we have to establish a fact, whether how the fraud had happened, or what all the uh, objectives of the persons doing that fraud, etc. And with regards to the audit, its main objective is to verify the financial statements, that whether they display a true and fair view, and that's it. To obtain a reasonable assurance. And what is the scope of investigation? It is the scope of investigation is governed by the one who appoints the investigator. So the scope is defined by them, and the scope of audit is widely And in case of a statutory audit, it was determined by the provisions of law. And with regards to the periodicity for an investigation is unlimited, but for the audit, it is very limited to the period doing audit, whether it was of annually or etc., or quarterly, half yearly, etc. And depending upon the nature, it requires a detailed examination, but it involves some test checking, like tests of controls and few audit sampling we use, right? We just do some test checking also, and the inherent limitations in the investigation is there were no inherent limitation because there is no restriction on the scope, and moreover there was no restriction on the scope and periodicity, right? And so, but auditor suffers from the inherent limitations. And what kind of evidence they have to form? They have to form a conclusive evidence. And auditors mainly concerned with the prima facie evidence because it's not an investigation. And observance of accounting principles, it's analytical in nature and requires a thorough mind and capable of observing and collecting and evaluating the facts and all. And it's governed by the compliance of generally accepted accounting principles. And with regards to the reporting, the outcome is reported to the person on whose behalf the investigation was carried out, and the outcome was and if it's an audit, the outcome was reported to the owners of the entity. How to remember all these things in one go in your examination? First thing, for anything, first you have to remember why it is doing, what is its objective, and how, to what extent an act was done, objective and the scope, and to and the till how long it was done. It for the periodicity, the scope and periodicity go hand in hand. And you have to talk about the outcomes. What are they talking about? The outcomes with the evidence there and the reporting, these two also go hand in hand. So 5 points were completed. And obviously when we think of audit, we think of inherent limitations, right? And depends upon the nature also. Audit sampling and all, we do that mostly, right? And we are most concerned with the test checking, etc. So these 2 points also could be remembered in that way. And now we'll see what are the steps in the investigation. First thing, what you have to do, you have to determine the objectives and the scope. For doing not only investigation, any kind of job or task, you have to determine the objectives and scope of that, and formulate the investigation program, like an audit program, even investigation program, a series of instructions how the investigation has to be carried out. And examination and study of various records by reference to appropriate audit evidence. We have to review the, like, all the records on statements in which the particular situation or that fact or happening had occurred. You have to examine those, why there was an examination or not a review. And in an audit you usually review the things. In an investigation you examine the things in a very keen manner, right? And in analysis and processing interpretations of the findings and preparations of the report and drawing up the conclusions. These steps you have to remember. This is a important question. And these were the steps of the investigation. If you remember this, that was far more enough for that. And what are the types of investigations? There were two types of investigations that were by statutory and non-statutory. Non-statutory is like the third party's done. Statutory under any court or under any kind of government, central government, etc. Investigation into the affairs of the company. We have seen in our company law, right? Investigation of the ownership of the company. You need not read separately again for the audit. What all the points you have remembered in law, just refer the chart book or whatever the things with regards to investigation, just write the same thing here. You need not read, as I always say, you need not read the same matter from different pages, different books, etc. You have to know where to put that format or where to put that matter in. That's it. Okay, even for the SEBI LODR regulations also, you could read from law and just do that. And you have already completed, since there were 2 days for audit, it would be more helpful also. And you have completed a small little portion of law revision also. Yeah. And with that said, we'll just see the statutory investigations and all. The inspector was appointed by an order of central government or on receipt of report by the registrar or intimation by a special resolution passed by the company Yeah, are you striking the points in the law, right? That the affairs of the company were investigated or through public interest. And if it's SFIO under 212 on receipt of report of registrar inspector on intimation of special resolution, public interest or request from a central government department or a state government or any other cases, and that is with regards to the investigation with respect to the affairs of the company and with regards to the ownership also. You remember what all the points that you have what all the points that you have read in the law, you could write the same thing. And with regards to the non-statutory investigation on behalf of incoming partner, investigation for valuation of shares in private companies, investigation on behalf of a bank, investigation on behalf of any frauds or there are any kind of frauds that had happened, investigation with regards to that. But it was mostly done by the management itself when they have come to know the fraud that was happening in the company, investigation on behalf of any individual proposing to buy the business, and investigation in connection with the review of profit and financial forecast. You see, the incoming partners and who want to buy the business, and with regards to a bank that was giving an advance and etc., right? They are saying it is an investigation. But what previously we have learned, they also do due diligence. But what is the difference between a due diligence and an investigation? You see, due diligence is when you check all the facts and information about anything before making a decision. That is, due diligence was carried out to take an informed decision. But whereas investigation is done when you try to find out more information regarding something that you think that might go wrong. That is, you have a pre-notion that there was something that illegal or something that was wrong that was happening in the entity, and you wanted to do investigation. You have some sense, you have some sixth sense saying, or you have been, or there's an air of something that was going wrong. For due diligence, it is just to take uninformed decisions. You're doing due diligence, and that is a slight difference between due diligence and investigation. You see, investigation can be done by what incoming partner, private companies, and by bank, or it could be done by management when they come across any frauds, or on behalf of individual, or in connection with review of financial forecast, etc. And these were the things, and these were the who could be appointed as an inspector. It could not be a firm or body corporate or any kind of association, only an individual. Other than inspector is individual. That's it. And it's not like an audit firm that could, a firm of partners could go and do the audit. It is inspector is an individual. He has an individual. And these were some duties and some rules with regards to the inspector, that he should not keep books in his custody more than 180 days, and he could inspect, take an examination of both, and have powers of civil court. We know the powers of civil court in law, right? Do check that out. And duties of the officers and the employees of the entity, that they have to cooperate with the inspector. And these all the things which we read in law, right? You could just go through and need not read up from the audit here. And it was mostly the same. Like, the employees of the company has to just give all the documents or the information that were relevant for that investigation and all. He should not keep books for more than 180 days, and could examine on oath the persons he wanted to do. And all the powers of civil court, issuing summons, etc. And assistance of officers to the government to the inspector. He could take assistance from the government officers. And if the evidence was placed outside India, then what the inspector could do, the inspector could just go and ask the court, and the court, if it thinks okay that information was outside the India, then it could contact the court in the outside India. And that court, what it does the information and all, it would give to the court in India, and the Indian court will give it to the inspector, and he completes his investigation. That is simple. And inspector report, in inspector report, he shall be submit the report to the central government who had appointed him. And there is no obligation that he has to give that report to the entity that under the entity that had undergone the investigation. If they want any kind of report, they have to make application to the central government and get those report. And we'll see the types of frauds, investigations of frauds, etc. See what are the types of frauds. Fraudulent financial reporting, misappropriation of assets, fraudulent entries, sales frauds, collection frauds, expenses fraud, data frauds, payroll frauds, technology related, banking related, and other frauds. You see, do you have to remember all these under all things? It is near to impossible, right? But how could you do this, or how could you overcome this difficulty? It is just by giving a newspaper reading. That don't train your mind to memorize the things. What you have to do is, you have still 2 days left, right? Just see the papers that were there, open the page, and just read it 3 times. First day, today, after this frantic hour, read this page for 3 times. And tomorrow, read it for 2 times before sleep and let the subconscious mind work. And later on, you have one more day, right? And don't read. Read just for one time and then try to retrieve the information. Okay? You see, ICI only test the retrieval capacity and how calm you could be in the situation, right? You have to test your retrieval capacity. And with that said, we'll just move on. You just give a newspaper reading like 3 times today and 2 times tomorrow, and you retrieve that again the day after. And that's it. And we'll see the indicators of fraud now. This even the fraud risk indicators which we have discussed in our standards on auditing on our day one. Those were the same points that have been repeated. As I have already said, don't repeat or overcomplicate the things. These were already in the syllabus. This is just a repetition. You need not, you go and check the fraud risk factors in the audit pronouncement essays as per audit pronouncements in our Telegram channel, right? Go check that and check the fraud risk factors there. Those 4 points were same as this. You could just simply write down there if you want it. Or you see, when you, what happens when you read a lot of times or the same point from different pages or from different chapters, you get confused. That's the first thing. What you have to do is you have to cancel all the unnecessary portion and remember which was only unique, right? The for the investigations in the, that's what we have done for the investigation. We, what where from we have to learn this? We have to learn in law, right? You have to learn from there in law with regards to all the investigation on or provisions related to inspector and powers under civil court, right? You have to remember from that. And this fraud reporting is for newspaper. That's fine, newspaper reading. And this or fraud risk factors is from standards. And that's it. We have just completed our investigation, and now we'll see the forensic audit. Forensic audit and fraud, forensic accounting all stands the same. The main important point is just you have to know the definitions of all these. And now we'll see the definitions. Forensic is something that's suitable for use in court of law. Forensic, when anything that goes under all the evidence that you have obtained under forensic audit could be is eligible to be submit before court for as an evidence. Okay, that's a simple thing. And this is the definitions and all that. Don't worry if you haven't you need not remember the definitions of each and everything. You remember only one definition and write it the same. There will be various kinds of alternative answers for this forensic audit definition. What all you remember one single definition and it would be more than enough for you. And the thing that you have to remember is the difference between forensic audit and normal auditing. These were the definitions of forensic audit. Forensic audit is done in response to an event of financial investigation. Findings that conclusions were used as evidence in court to resolve the disputes. This is the definition you have to remember. Simple definition. And audit. What's the audit definition? It is mandatory and it measures the compliance of the reporting standards. And the auditor obtains a reasonable assurance on the financial statements, whether they are free from material misstatement or not. And that's it. This is the definition of the audit. And now we'll see the differences with regards to the objectives. What are the differences? For audit, it's true and fair presentation. They have to express an opinion on whether the financial statements possess a true and fair presentation. And forensic audit, whether the fraud has taken place in books or not. And the techniques. and techniques were substantive or compliance techniques that could be used. And for forensic, it is investigative, substantive, or in-depth checking. You see, what is the difference between forensic audit and investigation? Both were like the when both were done when the fraud has taken place, etc. Right? Under investigation, it is not an independent examination. It is an examination by any kind of banks, like a investigation that for a bank to give a loan could be done by its employees, etc. That's not so independent. But forensic audit was so independent that it could be used, that evidence could be used in court. That is a slight difference between the forensic audit and investigation. And the period for this normal accounting period for the audits and forensic audit, there were no limitations. And for the verification of stock estimation and realizable value for all assets and provisions, liabilities, etc., relies on management representation, and independent verification is done, like direct evidence was taken by the forensic auditor. And for the off-balance sheet items like bank guarantees or contingent liabilities, etc., they watch for the mathematical accuracy. And for the under the forensic audit, they check for the regulatory and proprietary of these transactions. What does proprietary means? Proprietary is those transactions were taken under sound business principles, that a business was done to obtain profit. And if any kind of transaction that were taken, like they have given letter of comfort or guarantees to the subsidiary, which was for taking a loan, for taking a loan which is not properly utilized. That's again a thing, right, to be examined there. And if there were any adverse findings, what they have to give a negative opinion, that is an adverse opinion or disclaimer of opinion or a qualified opinion. And legal determination of fraud impact and all the consequences for fraud happening, right, that would come under the forensic audit. And that's it. Well, now we'll see what all the forensic auditor is often involved in, what all the areas he was involved in. For fraud detection, for the first thing, and computer forensics, like yes, he was developing some applications, or he's doing some systems in order to know and analyze the financial evidence, etc. And fraud prevention, as we have said, they could also he could also develop the implementation of some systems, etc., for prevention of that fraud, like a remedial measures. And for the providing expert testimony with regards to that. And these were the things for fraud detection and computer forensics to detect the fraud, that is building applications, etc., to detect the fraud and analyze the financial statements. And fraud prevention and providing expert testimony about assisting in the legal proceedings, or giving the expert witness, etc. That is the forensic auditors were retained by lawyers. They were all obviously retained by the police forces, insurance companies, whether they have to give the claim or not, and whether by the government authorities, banks, courts, and business communities. And these were all the services that were rendered by the forensic auditors. And first, we'll see what all the services that were rendered by the forensic accountants. They could render the criminal investigation. Criminal investigations, because courts could hire them. Yes, criminal investigation, professional negligence cases for the business communities or the government or regulatory authorities, etc. And for the arbitration services, again by courts or banks, and fraud investigations and control reviews and settlement of insurance claims, as they were hired by the insurance companies. And dispute settlement, again by the dispute settlements in business communities, etc. And the criminal liabilities, professional negligence, arbitration, dispute settlement of insurance, fraud investigation, and control reviews. When you link that to this, there's no point that you could miss a thing. And second thing, you could remember two questions in one go. That's benefit of linkages. Okay, and what are the services that were rendered by the forensic auditors? First, they could craft the questions. As we have said, what is the initial thing that any auditor could do while he doing an audit or any kind of investigation? First thing, inquiry. Inquiry, how do they ask questions. That is crafting questions to be posed and responding to the questions posed, and in identifying the documents to be requested, and identifying the individuals to the most knowledgeable of facts. You see, all these were the elements of inquiry, questions that were required to be asked, and responding to the questions posed, whether it is an yes or no or not applicability, etc. That all responses he was also have to give, and that is like a multiple choice question, etc. And you have to identify the documents to be requested and individuals, and these were with regards to the inquiry, and conducting research relevant to the facts of the case and identifying and preserving key evidence, and evaluating the produced documentation. Here he is identifying the documents that were requested, right? Now he got the documentation and he's evaluating those documentation and analyzing the produced records and all, and identifying the alternative means to obtain key facts and information, and providing questions for deposition and cross examination of the fact. You see, this is a complete cycle. First he's doing inquiry with these 4 points, and then he's doing some research with regards to that, and identifying and preserving the key evidence, because he has to submit that in court. Okay, and now he requested some documents, etc. Right now he has to evaluate that and analyze the records and all, and identify some other means of obtaining key information, that is other ways other than the inquiry. He has to obtain some information, etc., by just by observation, etc., and providing questions. This is for cross examination. This is for cross exam. That is more corroborative evidence is more uh, appropriate for, right? So all the from various information from various sources or evidence from various sources lead to only one kind of conclusion, that is more corroborative evidence. So he is posing some other questions for the cross examination, and that's it with regards to the forensic. And now we'll see the process of forensic accounting and forensic audit techniques, and we'll just complete the forensic audit here. First thing, initialization and develop a plan, and then obtain relevant audit evidence and perform analysis, reporting, and court proceeding. Okay, what is initialization? All the 200 series, let it be every, as we have said, everything boils down to the standards, right? Because auditor has to do account auditing as per the standards on account standards on auditing. Auditor has to do auditing as per standards on auditing. First, 200 series, initialization, initial terms of engagement, etc. Initialization, and you have to develop a plan on how to do the audit and obtain relevant audit evidence. That is, you have to obtain evidence, and then perform analysis. That is, you have to do some analytical procedure and analyze the things that were there and relationships, etc. And then you have to give a report and then submit it to the court. That's it. This was so simple. If it was asked, it would be asked for 5 good points, because you have to get that right. You have it, you have listened it here, you'll write that and you'll get marks for that. And these are forensic techniques, forensic audit techniques. First thing is analytical steps. So they have to understand the business and then identify the possible frauds that could exist and catalog possible fraud symptoms. Have you seen these similar kind of steps somewhere else in 300 series? First, you have to understand the business and its environment, and identify the risk of material misstatements, etc. Right? Now, this is already a fraud, right? So we are identifying the possible effects of the fraud. Just modify the points, and just you could write it the same way. Understand the business and possible frauds that could exist, and catalog of possible fraud symptoms. That is a list of the frauds that you are expecting could happen. Okay, and then technology steps. Use technology to gather data about symptoms. Why they have used technology steps here? Because even the forensic auditor is involved in computer forensics. What he has to do, he has to develop some applications to assist the analyzing and presentation of financial evidence, right? So now he's using that technology here to analyze the data, and then analyze the result, and then detect the automate detection procedures. And this was with regards to the investigation steps, investigate the symptoms, and then follow up procedures. These were the forensic audit techniques. And what all the qualities that the forensic audit should have, this one you could just read it and then go. And now we'll move on to our next topic, that is SEBI LODR regulations. Audit committee, nomination, remuneration committee, risk management committee. We'll see one after the another. With regards to audit committee, minimum 3 directors and at least 2/3 of the members of audit committee shall be independent directors. At least 2/3 is the amendment here. And what? Minimum 3 directors we know. And at least 2/3 shall be independent directors. For an audit committee, what the another kind of criteria we'll see. A listed entity having outstanding superior rights, equity shares, all the members shall be independent. This is the old one only. So it's easier to remember. Audit committee, minimum 3 directors, at least 2/3 shall be independent directors, and the entities having SR rights, all members shall be independent. And we'll see the nomination and remuneration committee, 3 non-executive directors. For audit committee, 3 directors, minimum 3 directors, here 3 non-executive directors, and at least 2/3 of being an independent directors. Same for the audit committee also, but for the chairperson, they have mentioned that it should be an independent director. Why there was special consideration for chairperson that he should be an independent director? You see, the role of the nomination and remuneration committee is mostly, what's the role of nomination and remuneration committee is evaluating the skills, knowledge and experience of the board and preparing a description of role and capabilities of a required for an independent director. So what they wanted to tell is that what's the duty of the nomination remuneration committee is that in order the company to turn fully into a family business, independent directors should come in place and give their experience or expertise. So what do? What they evaluate the skills, knowledge and experience of the independent director for the appointment and deciding the remuneration of the independent directors. So the chairperson should also be independent in order to appoint an independent director. Okay, with that said, the committee may use external agencies like management experts only. The committee may use external agencies by considering various diverse candidates, and evaluate time commitments and when identifying suitable candidates. Thus, time commitments is they cannot go on checking out resumes of thousands and lakhs of candidates. So they could opt for any agencies like outsourcing of the independent auditors after shortlisting of 20 to 30. They could decide who shall be appointed as an independent director. So a nomination committee having at least 3 non-executive directors, at least 2/3 being independent directors and chairperson being an independent directors, what do? They evaluate skill, knowledge, expertise of the board members in order to be appointed into the board as an independent director. They could use external agencies also. And these are the amendments regard to independent director. We'll see them after we'll see the risk management committee. After we see the risk management, we'll go to independent director amendments. And in risk management committee is not applicable to all companies. It's applicable to top 1,000 listed companies. Top 1,000, how we know it's top 1,000? Market capital valuation. And a high value debt listed entity. It's a high value debt listed entity, and if it's a top 1,000 listed company, if it satisfies any of the criteria, it has to form a risk management committee. What's the role of risk management committee? Why they require a risk management committee? In order to formulate a risk management policy. What does that risk management policy consist of? Risk management consists of, whenever there is any kind of risk, you prioritize the risk. First, what you have to do, you have to identify the risk. And after identifying, you have to find some remedial actions in order to mitigate that risk. So, a framework for identification of internal and external risk and measures for risk mitigation. That is remedial measures. And why do we need to identify the risk and mitigate that risk? In order our business to survive, in order our business to continue. Business continuity plan. The next role is to ensure that appropriate methodology, process, systems are in place to monitor the evaluated risk. We see in SMPE, right? MAVE, DWAI, Six Sigma. After implementing any kind of remedial actions or any kind of solution, what do? They monitor that. The same applies here. After introducing measures for risk mitigation, what do? They monitor. And what do they monitor again is that risk management policy. First, they monitor in a micro level the measures of the risk, and in a macro level the risk management policy itself they monitor. To monitor and oversee implementation of risk management policy. Okay, how long they review? They review the risk management policy at least once in 2 years. At least once in 2 years. To keep the board of directors informed about the decision of nature and content of its discussions, recommendations, and actions to be taken after this committee. These committees, what they were accountable to the board of directors in order for a proper maintenance of the business or business. So whatever they are accountable for, they are accountable to board of directors with regards to the discussions it had taken or recommendations or actions that it had taken. And with regards to the appointment, removal, and the terms of remuneration of chief risk officer also was under risk management committee. Now we'll see the amendments with regards to independent director. An independent director should always be a non-executive director. We know that. And he should be a person of integrity, expertise, and experience. Why we have to look only for the independent director, the experience, expertise, and integrity? You see, business could be a family business. But in order to expand the business, in order to expand the business into a large scale and making it a listed company, a wide range of data or a wide range of skill, knowledge has to be there. So every person in the family or only the promoters cannot acquire so much of knowledge. So what do they hire? They hire expertise in such recommended fields and appoint them as an independent director in order to continue the business or expand or scale their business. So that's why nobody could appoint someone or some or the other as an independent director or enter into the company. He need to have some expertise in order to be appointed as a director, independent director. So for that, we have to check the integrity, expertise, and experience of that person. In order to enter the company, we have to justify the appointment to our shareholders, being promoters. And obviously, the independent director should not be a promoter of the company or anyone related to the company's promoters or directors, because he's independent, right? He should be independent. And it's also recommended by company law. No financial relationship with the company or its promoters or directors apart from receiving remuneration. Apart from his remuneration, independent director's remuneration, he should not have any financial relationship. And he should also check whether his relatives were holding not more than 50 lakh rupees or 2% of paid up share capital of the company. You see, we'll find few monetary limits such as 50 lakhs or 2% or some other fixed amount or to a plus of a percentage. When it exceeds more than 50 lakhs or more than 2%, whichever is lower, whenever we find any fixed, an absolute number and a percentage number, it was always more than. That's actually a blunt reminder for us in order not to get confused in our examination. So we'll see the independent director should not have any relative holding more than 50 lakh rupees or more than 2%. This more than applies to both 50 lakhs and 2% of the paid up share capital. 2% of what? Paid up share capital. And with regards to independent director himself, in last 3 years of the current financial year, that is total 4 years, current year plus last 3 years, he should not have any other pecuniary transaction or relationship with company amounting to 2% or more. You see, you find an absolute monetary limit and a percentage, it is exceeds more than. Here, the 2% is included. If he takes transactions equal to 2%, it's a pecuniary transaction of its 2% of its gross turnover or total income. But the happiest part is it's talking about here gross turnover and it's talking about paid up share capital. Paid up capital. For the relative, paid up capital 2%. For the pecuniary transactions, you think it as a sale or purchase. Sale or purchase in what? P&L. The highest amount is turnover, right? You remember like that. It's easier not to get confused in examination. And the independent director should not have connection with non-profit organization that receives 25% or more. Again, a percentage without an absolute monetary limit. It includes that percentage, includes that amount. 25% or more, 2% or more of its receipts, turnover again, total income or total receipts or corpus from the company or its promoters or directors or holding subsidiary or associate companies. And the independent director should not be less than 21 years or not be a non-independent director of another company on the board of which any non-independent director of the listed company is an independent director. Okay, we'll see. With an example here, company A, company B, person A, person B. In company A, person A is a non-independent director. In company B, person B is a non-independent director. So what had A asked B? There was a requirement of independent director in company A. So you come and join as independent director. Then what B has said? Even we have requirement of independent director in company B. You come and join as an independent director. This arrangement should not be there. They were talking about that. So such arrangement should not be there. An independent director who resigns or is removed, that is a casual vacancy of independent director of a listed entity, it shall be replaced by a new independent director or at the earliest but not later than 3 months from the date of such vacancy. That is not later than 3 months he have to be refill that independent director requirement. Okay, this is what with regards to amendments of independent director. To amendment of appointment of board of directors to be or appointment of manager, or with regards to information to shareholders, the procedure for the appointment of board of directors or manager was discussed in law. What was discussed here is the shareholders approval. What are the communications with shareholders that have to be done. So we'll read these 2 points simultaneously, even though they were 2 separate points. For appointment of any board of director or manager, shareholder approval is a must. It has to be obtained when? Within next general meeting or 3 months from the date of appointment. That is, this approval is taken after the appointment of board of directors. But if that person was rejected by the shareholders previously in any general meeting, a prior approval has to be taken. Same provisions we could see it in additional director, right? Board of directors could appoint additional directors, but they should not appoint him as an additional director if he was rejected or not appointed in a general meeting. So those provisions were these, and a notice what the shareholders would approve or disapprove by on what basis. We board of directors or the management or audit committee or NRC committee have to give the resume of the board of directors or the proposed members, what all the information they have to be given. The notice to shareholders must contain a detailed explanation and justification for recommending such person for appointment or reappointment. On basis of such explanation and justifications, shareholder will either approve or disapprove or not approve. These were with regards to provisions of appointment of directors, what all the shareholders approvals have to be taken. And with regards to information that have to be given to shareholders on the occasion of appointment of board of directors or managers is that what they have to give. They have to give a brief resume of the director, the expertise of such director, and any other relationships with between the directors, and what all the directorships it has in what all companies, and what all the memberships it had in what all committees in past 3 years. From past 3 years, what all the directorships he had, what all the memberships he had, directorships in entities, listed entities, and memberships in the committees, and shareholding of non-executive directors. These are all the information that have to be given to shareholders on the occasion of appointment of board of directors or manager. And what all the additional information that have to be given to shareholders was information to shareholders with regards to annual report. They have to give the annual report in soft copies or hard copies. When they have to give not less than 21 days before AGM. If you have email addresses with the company of the shareholders, with email addresses of shareholders with the company or depository, you could soft mail them, or you could give soft copies and hard copies if they have requested. The statement of significant related parties are non-mandatorily reviewed by the audit committee. What are the things that they have to give mandatorily review? management discussion and analysis, management letters and letter of internal control weakness, and appointment removal in terms of remuneration of internal auditor that has to be reviewed, and the internal auditor reports and statement of deviations and the quarterly statements of deviations, including the monetary agencies applicable and annual financial statements of the funds that were utilized for the purpose in which whether they have been raised for, but not the statement of significant related party transaction. This had been skipped. This is an amendment. Please make a note out of it. And the appointment of non-executive director as a chairperson of the board of top 500 listed companies as defined by the market capitalization at the end of the previous financial year. This provision will not apply to listed entities. That is, a chairperson should be a non-executive director. But this will not be applicable to listed entities when the promoters were not identifiable. That is, they do not have share capital. So this this non-executive director provision is not applicable to them. They can appoint some other individuals as their managing director, etc., who is not a relative. That's it. A listed entity shall submit a quarterly compliance report on what? Corporate governance in format specified within 21 days from the end of the quarter. Yes, as we have completed major portion of SEBI LODR regulation, that is Audit Committee on Corporate Governance, the two things we have skipped is the limited review, that is 45 days after completion of a quarter they have to give a limited review, right? That is so simple, you could just go through that. And the another topic is we have missed is the vigilance mechanism, etc. And that's it, and nothing much more than that. We could just we could just move on to the next topic. We have also discussed the risk management committee, and now we'll move on with the peer review amendments and peer review timelines and quality review timelines and recommendations of quality review all in one go. Amendments of peer review, whenever you find any kind of technical standards, peer review as per technical standard or ethical standards, what all you have to add on is audit quality maturity model is the only add-on. That was the amendment. Now we'll see the further processes. Reviewer. A reviewer shall be a member duly approved and empaneled by the board on fulfilling of few qualifications as prescribed. So a branch reviewer is also a reviewer who peer reviews the branch of a PU. That is practicing unit reviewer appointed to conduct the peer review of the branch of a practicing unit. New audit, this is a new definition. You see, with the respect to new unit, there were two criteria. First thing is a time, that is 12 months time, and second thing is assurance services. If the practicing unit was under 12 months, that is first condition. If it's under 12 months, you need not see for the second condition, that is assurance service. So it's a new unit. If the first condition 12 months was crossed, you have to go for the second condition, that is assurance services. That is, assurance service should not be made in that year, in the whatever the time period that it was established, till it has established. So if it's 12 months below, it's a new unit. If it gives or it provides or it do not provide assurance services, if it crosses it, if it exceeds 12 months period, it should not give an assurance service to become a new unit. So all the units which do not give assurance services even after 12 months were also considered as new units. A new unit means a firm established for less than 12 months immediately preceding the date of receipt of application of peer review, and which may or may not have rendered any assurance services during the said period, or a practicing unit is in existence for a period exceeding 12 months but not rendering any assurance services. Okay, that's the definition with regards to new unit. And the criteria of peer review, there were no special changes with that. Mandatory, voluntary, special case. And mandatory is peer review can be mandated for such practice unit as decided by the council. Okay, and voluntarily is something so remotely applied to the board for a peer review to be done. Any practice unit may suo motu apply to the board. For the special case is that board on receipt of any information is of the opinion that it requires a special review for such practicing unit, it may mandate the practice unit to go under a peer review process. So mandatory, voluntary, special case on receipt of information. Peer review mandate is only the significant amendment that had happened here, and we'll discuss that. Previously, the practicing units which undergoes peer review were categorized into 2 levels. Now they were divided into 4 phases. That's it. And it's so simple also. Peer review certificate by practicing unit should be a prerequisite for undertaking audit of all entities falling under phase 1, 2, 3, 4 of the mandate. What they are saying is that in order a practicing unit to go for or apply to do any kind of audit, it need to have a peer review certificate. When you will get peer review certificate, a peer review certificate will be given when you undergo the process of peer review. Issuance of peer review certificate. After the peer review certificate or after the peer review process, if the peer reviewer had given a unqualified opinion, that is a clean report issued by peer reviewer, the peer review board secretary shall place the report before the board. Which board? Peer review board, for consideration and issuance of peer review certificate to the practicing unit. That is, as soon as the reviewer submits the report, what the board shall do? The board shall give a peer review certificate to the practicing unit, which is a prerequisite to get audits. These certificates issued by the board shall be noted by its meetings. Obviously, there need to be a record, so they note them. And certificate shall be duly signed by chairman, vice chairman and secretary of the board. Who shall sign the certificate? Secretary, chairman and vice chairman. The peer review board secretary shall serve peer review certificate upon practicing unit and update that list on ICI website. Okay. That's the duty of peer review secretary. He updates it ICI website. Peer review certificate issued to a practicing unit shall be valid for a period of 3 years. Okay. That's a validity time period. And now we are seeing the phases right here. Phase 1. That's where the effective date is 1st April 2022. A statutory audit of entities whose equity or debt securities are listed in India or abroad. All the practicing units are undertaking statutory audit of any entities whose securities were listed, whether in India or abroad. Phase 2. That is 23. 1st April 23. 22, 23, 24, 25. Phases. 2 plus 1, 3. 1 plus 1, 2. 4 plus 1, 5. Simple. No need to get confused. Undertake statutory audit of unlisted public companies. Why listed companies were not there? Listed companies were already included in phase 1. Previous year only they have included. So for the next year, it was most like a India's transition. Same. Unlisted public companies who's having paid up share capital not less than 500 CR, that is minimum 500 CR paid up share capital, aggregate total turnover minimum 1000 CR, aggregate deposits loans that were taken from banks or financial institute minimum 500 CR as of 31st March of previous financial year. Unlisted public companies having paid up share capital minimum 500 CR, aggregate turnover minimum 1000 CR, aggregate deposits taken minimum 500 CR of previous financial year 31st March, or this is for the company, that for the client, this is for the auditor, this recommendation, or this is an or practicing unit rendering attestation services and having 5 partners or more. 5 partners or more. Okay, that's for the company and for the auditor. There's an or condition, not an and. For the phase 3, 1st April 2024, statutory auditors of the entities who raised funds from public or banks or financial institutions over 50 CR during the previous year period under review. That is, if you take 50 CR, no, it does not, the phase 3 is not applicable. If it's more than 50 CR, that is 51 CR or 50.5 CR, phase 3 is applicable. That's for the company. But for the auditor, with an or condition, that is either the client or the auditor, whoever satisfies, it comes under that. A practicing unit rendering attestation services having 4 or more partners comes under phase 3, peer review mandate. Phase 4, with effective from 1/4/2025, audit of branches of public sector banks. That's the client, public sector banks, or practicing unit rendering attestation services having 3 or more partners. Phase 4. That's it. It's so simple to remember. Now, with regards to peer review board, how many members do they consist of? They consist of minimum 6 members and a maximum 12 members, and at least 50%, not less than 50%, that is at least 50% are members of the council. Which council? ICA council. Eligibility of reviewers, 7 years of assurance practice experience. Have you heard this assurance practice experience somewhere? In new audit, new unit, assurance service. Now, okay, we have read this issuance of peer review certificate, right? Now we'll go with amendments with regard to peer review process and reporting by peer reviewer. A practicing unit which decides to get peer review, that is voluntarily, or initiated by board, that is mandatory or special case, then practicing unit shall make an application in form 1, that is it need to give recommendation, it need to give answers or questionnaire. Application cum questionnaire is form 1. So it all starts with form 1, the peer review process. And after submission of that peer review form 1, within 3 working days, the name of 3 reviewers shall be recommended by board to practicing unit. After submission of form 1, that is the initiation point. Within 3 working days, 3 reviewers, names of 3 reviewers were given by board to practicing unit. Then after that, within 1 working day, the practicing unit shall select 1 out of the 3 recommended reviewers. Then after selecting the peer reviewer, the board shall appoint peer reviewer selected within how many days? 2 working days, and intimate the reviewer to submit declaration of confidentiality in form 2 to practicing unit within 2 working days. Okay. After selection within 2 working days, what do the board do? Board shall appoint the peer reviewer selected and ask the peer reviewer to submit form 2 and declaration. What that form 2 is? Form 2 is declaration of confidentiality within 2 working days. Then after submission of form 2 within 2 working days, practicing unit shall provide form 1 that is submitted to the board to the reviewer. That is, they are exchanging the information. In order to empanel into the board, the reviewer shall submit the declaration of confidentiality to the board. Now in form 2, the reviewer is submitting to the practicing unit. Practicing unit submitted form 1 to the board. Now submitting the form 1 to the peer reviewer in a span of 2 working days. Then after submitting of form, as soon as possible and or immediately, what the peer reviewer should do? Peer reviewer shall intimate about the proposed visit, that is on-site visit, and proposed sample selected to be kept ready by practicing unit, and the proposed sample selected are to be intimated by the peer reviewer in form 5, and the additional clarification in form 6. The samples that were need to be selected were sent in form 5 by peer reviewer to PU, and additional clarification in form 6. And within 1 day, the PU shall submit additional information to the peer reviewer after from submission of form 6 within 1 day, within 1 working day. And from that, after additional information submission within 2 working days, the selected assurance service engagement, that he would like to review and intimate the same to PU in Form 5. After that, he had to select some engagements that he wanted to review and submit it to practicing unit in Form 5 in 2 working days. And within 2 working days again, the PU shall keep ready the necessary documents of the selected assurance services, and from then, within 20 days, the peer review process shall be completed. And within 6 working days, if it's a new unit, the peer review process shall be completed. First, Form 1 is submitted. Then within 3 working days, names of 3 reviewers were given. Then within 1 working day, select 1. And see, all that is 1 only. Except for additional information, all that time limits were 2 working days only. Except for additional information. Name of 3 reviewers, select 1, and within 2 working days he shall submit Form 2, and within 2 working days from then PU will submit Form 1, and peer reviewer will give Form 5 and Form 6, and then in Form 5 he will select what all the engagements he wanted to then, and within 2 the PU will have to keep ready the information, and within 20 working days peer review process complete. After the peer review process was completed, how the peer reviewer will report that. First, after completing on-site review, peer reviewer shall submit the peer review report to the board along with Form 9. In Form 9, a copy of report shall be forwarded to the board and the PU. If the systems and procedures in practicing unit are deficient, communicate his findings to PU in a preliminary report. If the systems and procedures in the practicing unit are deficient, that is, that forces the reviewer to give a qualified opinion. First, he'll give preliminary report to the PU. He directly don't go to the board. He gives it to the PU. Within 2 working days, make its submission and representation, that is response of the PU in writing to the reviewer. That's one thing. After that, if the reply was satisfied, he'll submit an unqualified peer review report, that is a clean report, in Form 9 along with Form 9 to the board and forward it to PU, send a copy to PU. And if it's not satisfied by the reply of the PU, what he'll do? He'll submit a qualified peer review board along with Form 9, and a copy shall be submitted to PU. And what all the documents he have to accompany with the peer review report, whether it would be a qualified or unqualified, annexures to that report has to be accompanied, and a copy of questionnaire as received from the practicing unit, that is Form 1, and the list of samples selected by him, Form 5. Preliminary report, when the systems and procedures were deficient, the preliminary report that he submitted to PU. And the peer review board secretary shall place the report before the board for consideration. When there was a qualified report, when he gives a qualified report, the board may decide for follow-on review after a period of 1 year from the date of issue of report. So these are the process and reporting process by the peer reviewer. And now we'll see the process of quality review. First, selection of the audit firm and the technical reviewer will be done, and the technical reviewer will be sent a offer letter. Then what the TR will do, he'll convey his acceptance by sending the declarations for meetings, eligibility conditions, and furnishing this statement of confidentiality. First, he has to give a declaration that he had met all the eligibility conditions, and he had to submit a statement of confidentiality. And what is the second step? Intimation to the audit firm, that audit unit, that TR has accepted the quality review program, and TR will send the questionnaire, general questionnaire, for filling up and call for the additional information. And what the TR has to do, he has to carry out the quality review now by visiting the office of the audit firm on a fixed date with mutual consent. There is no time limit here. And TR has to send the preliminary report, that is preliminary report with regards to the quality review that he had done to the AU first. Then AU will submit its representation on that preliminary report. And then after such representation, then technical reviewer will submit its final report and a copy of annual report to the board, and AUs on their letterhead duly signed and dated within 45 days from the date of acceptance of the engagement. That is, whole or a quality review process has to be completed within 45 days, and AU submit within 7 days after those submissions, and TR has to submit within 7 days the summary of those findings and reply for the AU. And then the quality review group, what it shall do, it shall consider the report of the TR and then responses of the AU and make recommendation to the quality review board, and then quality review board will do some recommendations. We'll see what are all the recommendations that the QRB could do. First is make recommendations to the ICA council or to the director of discipline, etc., and they may also give advisory or guidance for improvement of the quality of services that were provided in the audit firm, and inform the details of non-compliance to the regulatory bodies, what all the regulatory bodies, etc., with regards to the entity in which they have audited, entities environment regulatories, and intimate to the audit firm under review as to the findings on the report as well as the action initiated as above. Any when there were when such non-compliance of any kind of rule or regulations by the regulatory bodies, it also has to intimate to the audit firm with regards to the actions that have been initiated or the proceedings that have been initiated. And in case of a review arising out of a reference received from a regulatory body, inform the results of review and details of action taken by regulatory body. That is, they have initiated the quality review by the reference from that was received from any kind of regulatory body. They have to also intimate such results to that concerned regulatory body, and consider the matter complete and inform to the audit firm under review accordingly. And that's it with regards to the recommendations of the quality review board. And also we'll see few time limits. These were the quality review cycle time limits, where mostly quality review has to be done once in a 3 years if the audit firm is having 20 or more partners, and once in 4 years if the audit firm is having 10 or more partners but less than 20, and once in 5 years when the audit firms are having less than 10 partners. Usually QRB selects up to 3 audit engagements for that particular audit firm. If it had some adverse findings and all, they can select more than 3 engagement also. And now we'll move on to our next topic, that is NEFRA applicability. And here it is. NEFRA rules provides that it has power. NEFRA has power to monitor and enforce the compliance with accounting standards and auditing standards. Okay, accounting standards with relates to the client. Auditing standards with regards to the auditor. That is, it governs both the parties, both the client and the auditor also. They have power to monitor and enforce compliance. They can ask to comply few rules and regulations. And that's it, a simple definition. Simple. NAFRA has power to monitor and enforce the compliance of accounting and auditing standards and oversee quality of service. Why quality of service? Because quality of service is seen with regards to the audit firm. So since they also have to, and they also have power to enforce the compliance of auditing standards, so they could oversee the quality of service and undertake investigation if needed for the following class of companies. Okay, in the companies whose securities were listed under any stock exchange, whether inside or outside India. And second thing is unlisted public companies having paid up share capital not less than 500 CR. That is minimum 500 CR. It comes to, if it touches 500 CR, it comes under the ambit of NEFRA, or having a turnover not less than 1000 CR. Paid up share capital, if it touches 500 CR and turnover touches 1000 CR, or at any kind of outstanding loads in any kind of year, any point of the year, if it touches 500 CR, then those companies comes under the ambit of NEFRA. Okay, and insurance companies, banking companies, and companies engaged in generation or supply of electricity. Insurance, banking, electricity companies or companies that were governed under any kind of special act also comes into the ambit of the NEFRA. Any body corporate or any company or any class or bodies of company which have made with reference to the by the authority, by the central government or public interest, that is government companies. And a body corporate incorporated or registered outside India. You see here, these were all incorporated in India, and here the securities were listed either in India or outside India. Here, a body corporate that was incorporated outside India, which is a subsidiary, means that outside entity is a subsidiary, or like think of like an entity that was incorporated in Mauritius, that is a tax haven, right? Even that companies were also included. They comes under the ambit of NEFRA. But you see, QRB, Quality Review Board, as we have already recently seen that QRB also could select three kind of companies files, right? Uh, then, then the Quality Review Board has to select apart from these five companies, because these five companies with these five categories had already come under the ambit of NEFRA. Only when NEFRA allows QRB to do so, only NEFRA gives a reference to do quality review of these companies, then only QRB has to do that. QRB cannot do the quality review of these five categories of companies. A small point to note. Okay. And this was an MTP question. And don't worry, we'll discuss all the MTPs and RTPs and other important questions tomorrow or day after tomorrow. By the time you go for your examination, we'll just have a important question discussion, a marathon for that, just 4 to 5 hours. That's it. Make a room for that, allocate room for that. Okay. And that's it. This is the NEFRA applicability. And now our next topic is NBFC. NBFC public deposits, whether it could accept public deposits or not, and what all the things regard to that. And NBFC categories, we'll see those two things in a go. And these were the audit procedures with regards to NBFC, which is accepting public deposits. Whether NBFC could accept public deposits, yes, it could accept, but it could not accept public deposits that are demand deposits. They cannot accept deposits or which were demand deposits. Okay. That is as and when the customer comes and withdraws the money, that is what we call as demand deposits. NBFC should not do that. Okay. Apart from that, any kind of non-demand deposits, if at all the NBFC is taking, what all the audit procedure the auditor had to do. First, he has to obtain the credit rating of the NBFC. It is mostly like when you are taking money of other people's or other third parties, you need to have some credit rating, right? You whether you were credit worthiness or not, you are something. This was similar to like a borrower. When we give loan to a borrower, we'll check the credit rating, right? Likewise, when we give deposits, like it's similar to like kind of a loan only, but another terms and etc., another kind of arrangement, we have to check the credit rating of the NBFC, that which it is accepting the public deposits, and if public deposits were within the limits or not. There were like a few kind of criteria that if at all this credit rating is this much, they could accept this amount of the public deposits from the public or not public, and we have to check those limits whether those were within those limits or not. And we also have to check upgrading or downgrading of the credit rating. Okay, if there was increase in credit rating, you could increase the acceptance of public deposits, and when there was a downgrading, you have to decrease those public deposits. And if the credit rating had been so down that you cannot accept any public deposits, then three things will happen. First, you have to immediately stop accepting the public deposits. And second thing is, all the existing deposits shall run to maturity. You have to immediately give those deposits. And third thing is, you have to report within 15 working days to the regional office of RBI where the NBFC was registered. And these three things have to be done. These were some important points with regards to this. And you have to test check the interest calculations, whether they are regularly paying on the due dates or not, and accepting public deposits only after a application has been made by the depositor. Like there could be a lot of money laundering that would be happening, like etc., right? So we have to check for the written application for the depositors, and you have to verify the deposit registers with that all kind of identities, etc. And these are with regards to the NBFC, which was accepting public deposits. To NBFC classification, before we used to have the types of NBFCs which was related, but now they have arranged in a hierarchical level, like a pyramid. If you think it's a pyramid, a base layer. Base layer is which is smaller in number and smaller in size, which is larger in number. Smaller in the size but larger in number. That is non-deposit taking NBFCs having asset size below 1000 CR. That is until 999 CR, it comes under base layer only. If it's non-deposit taking until 999 CR, it's in base layer. And NBFCs, it's peer-to-peer lending platform, PP, peer-to-peer lending platform. NBFC, account aggregator, AA, non-operative financial holding company, that is, it's actually holding company NBFC which has subsidiaries where the transactions were mostly done in subsidiaries. Holding company, what it does it just has subsidiaries. It owns subsidiaries, acquires subsidiaries, that's it. It doesn't have much of importance or priority because no transactions were there. NBFC is not availing public funds. Not much regulations need to be taken care. Okay, put it in base layer and not having any customer interface. What all comes into base layer? Non-deposit taking for NBFCs whose asset size is below 1000 CR. That is until 999 CR, base layer. NBFC peer-to-peer lending platform, base layer. NBFC account aggregator, base layer. Non-operative financial holding company, base layer. NBFC not taking public funds and not having any customer interface is base layer. And for the middle layer is something which is more of investment oriented or which is capital intensive. All deposit taking NBFCs, more risk. When public funds were involved, more risk. That's why more regulations were there for banks, right? All deposit taking NBFCs and non-deposit taking NBFCs having asset size 1000 CR and above. If it touches 1000, it comes to middle layer. It's a 4-figure. Until 3 digit, it's base layer only. If it's 4-figure, middle layer. Standalone primary dealers, infrastructure debt fund, capital intensive. Core investment companies, capital intensive. Housing finance companies, capital intensive. Infrastructure finance company, capital intensive. Anything that is industrial, infrastructure, investment comes into middle layer. Upper and top layer was super damn easy. Upper layer where NBFCs which are specifically identified by RBI as warranting enhanced regulatory requirement. That is few NBFCs which are more risk exposed. RBI thinks they require more regulatory requirement. It was kept under upper layer, and top layer it's usually empty. RBI, if its opinion that a substantial increase in potential systematic risk from any NBFCs in upper layer. You see, when risk was more, it comes under upper layer, and even there was potential systematic risk, it comes under top layer. That's it. These are the NBFC classification. Right. And now we'll see Iraq and NPA classification. Under the Iraq norms, we have to check whether the CBS is identifying and crystallizing the NPA. That is, crystallizing NPA means it was not recognizing the interest income on accrual basis. It has to be recognized the interest income on receipt basis. So they have to crystallize the NPA and examine whether the classification of advances were appropriate, that was standard, substandard, doubtful, etc., or loss asset, and whether they have secured or unsecured portion also have to be segregated correctly. And you have to review the date on which an asset had been NPA. NPA, when any kind of principal amount or interest amount or both have been, there was no credits for that, they have been paid for 90 days or more, then it would be regarded as an NPA. And when accounts were regularized, when an NPA, after payment of all the dues that were there, that all the interest amount and the principal amount, it would be regularized the same way. And you have to check what you have to check, whether that payment is from genuine resources or not. You have to check with that in order to reduce the NPAs only at the year end, or there might be any kind of payments of repayments of NPAs and all could happen only for kind of account regularization. You have to check the whether the payment was made from genuine resources or not, and if branch had provided further funds like carefully assessed sources, that the bank had given another loan, extra loan, for not making this old loan an NPA. That's why you have to check the NPAs with regards to customers. For one customer ID, you have to check if the customer had taken 2 to 4 loans and one loan had been an NPA, then under that customer ID, all the loans that the customer had taken would also become an NPA. And that's why we have to check NPAs customer wise. And if account has inherent weakness, we have to check that whether any kind of red flags, etc. And NPA shall be recognized on past due concept and not on the balance sheet date. And that's it. And now we'll see some provisions with regards to purchase and sale of NPAs. Yes, sale of and purchase of NPAs. First, you have to examine the policy that was laid down by the board of directors, all the procedures, valuation or delegation and accounting policies. And NPAs has to be sold or purchased only on without recourse base. Without recourse base is they're not claiming, they're not accepting any risk. That is, the risk was transferred to the purchaser. That is a buyer. Okay, and when you sell those NPAs, what all you have to do? You have to when the NPAs were sold, it has to be remained at least for 2 years as an NPA. That is, it the overdue was for more than 90 days, and at that day, from the date of that asset being an NPA, it has to be at least for 2 years in order to sell that NPA. Okay, that's one rule, and NPA has been sold only on cash basis, not on like a share-based payments, etc. There could be a lot of fraud that might be happening with regards to NPAs and also that's why they are specifically mentioned that it has to be sold only on cash basis, not on derivatives or share-based payments, etc. And bank shall not assume any risk. That is what without recourse they're talking about. And if the sale price of that NPA is less than the net book value, that there's a shortfall, you have to directly debit that into the P&L account if at all. The sale price was more, there was a profit, right? Then this profit you should not put it in the P&L account credit side. That's not your income. You have to create a provision for that. That's excess provision for any kind of a shortfall in the previous NPAs or forthcoming NPAs, you have to create a provision for that. And while you are purchasing NPAs, as you sell, you also could purchase the NPAs. When you purchase, the bank shall not purchase any NPAs which had originally sold. There shouldn't be a cycling that has to be happening, right? In order to make the window dressing or adjust the some ratios, etc. Banks, there could be agreements between banks for selling and purchase of NPAs and all. You should not purchase the NPAs that you have previously sold. Okay, that's rule number one. And NPA is subject to IRAC norms, and obviously, and 100% risk weights are given to NPAs. That is as like a loss asset. And any recovery from purchase of NPAs, first you have to adjust to the acquisition cost and then to the excess profit. Only here you have to create the profit, not at the time of sale. At the time of sale, you don't recognize profit, you recognize excess of provision. At the time of purchase, when you recover the NPA, that is, you recognize the profit when you recover the NPA, okay, in the P&L account. And that's it with regards to the purchase and sale of NPAs. And now we'll move on with operational auditor. There was a question, an important question with regards to operational auditor. We'll discuss that and then we'll discuss the internal audit applicability. Okay. And this is an MTP question that the management of M Limited, a manufacturing unit, does not accept the recommendations of improvements that were made by the operational auditor. Okay, they have done operational audit and the operational auditor had recommended few improvements in the systems, suggest an alternative way to tackle the hostile management, that management was not accepting the recommendations that were made by the operational auditor. First of all, we'll see what is an operational audit. Under the operational audit, what the auditor audits is that whether this step add value to the final product or not, whether that could be eliminated or not, so that the operations could be made more economically, or whether there had any kind of loopholes, or whether there were any bottlenecks, etc. What all he does is he just audits the operations, whether they are being effectively implemented or not. He has nothing to do with the financial statements and all. It's say it's like internal controls and all the operations that were in the entity. Okay, he audits only those whether they were operating effectively or not, as per the management policies or procedures, or the management's objectives and strategies, and that's it. And for that, the operational auditor is giving some recommendations and suggestions, but the management is not accepting those. In that way, what he could do, he could use the participative approach comes to help the auditor. This is the same thing, they have copy pasted the question and have just elaborated that. And as with regards to in this approach, now they were talking more about the participative approach. The participative approach, where the auditor discusses the ideas for improvement in a more friendly manner. Okay, the first thing, what all the key points that we have to remember here, it should be a participative approach. And in this approach, auditor discusses the ideas for improvement with the managers and who implement them, and make recommendations for those improvements. And by soliciting the views of the operating personnel, and operational audit becomes more cooperative enterprise. That is, you also have to take some views of the operating personnel, the one who were personnel is the employees that who were implementing that process, etc. And in participative approach encourages the auditee, that is the client, to develop a friendly attitude towards the auditor. Okay, so that they could make or take the recommendations that were made by the operational auditor. And in the participative approach, then the resistance to change becomes minimal, as we also have considered the views of the operating personnel, and we have been towards like a friendly attitude, and we are also discussing the ideas for improvements with the manager. So it had been the resistance for change, the resistance to change the operations and all becomes very minimal, and hostility disappear and gives room for feeling and mutual trust, and team spirit is developed. These all the things you have to remember. And the proposed recommendations are discussed with the auditee, and modifications have to be made, have to be agreed upon. And with this attitude, the auditor could absolutely, it becomes easy for him to implement all the recommended changes, etc. And that's it. You have to remember these two paragraphs, and that's it. You'll be done with this important question which have been in MTP and even in the RTP. And now we'll see the applicability of the internal audit. And these were the provisions applicable for the internal audit. Every listed entity has to do the internal audit. It need to have an internal audit function, and every unlisted public company whose paid up share capital is 50 CR or more, as soon as it touches 50 CR, internal audit function has to be implemented. And turnover 200 CR or more, and outstanding loans at any point of the year exceeds 100 CR or more. You see, when the loan amount touches 100 CR, whether the internal audit function would be applicable? No, a big no. This is a imposter here. It is when it touches 50 CR paid up share capital applicable, 200 CR turnover applicable, and outstanding deposits 25 CR or more applicable. But only when the loan exceeds 100 CR or more. After, when it touches 100 CR, it is not applicable. Only when it exceeds 100 CR or more, internal audit function is applicable. And for every private company, we have to check the turnover. And turnover, when it touches 200 CR, it was applicable. When it exceeds 100 CR, when the outstanding loans were 100 CR, the maximum loan was 100 CR, then internal audit function would not be applicable. Only when it exceeds the 100 CR, that is 101 CR or 100.5 CR, then only the internal audit function is applicable. There was an imposter here. We often forget that, and usually include that 100 CR also. There's a question with regards to that. We'll discuss in tomorrow or next video, where we'll be discussing all the MTP, RTP, and important questions. And now we'll just move on with the management audit. And yes, management audit. First, we'll go with management audit. Yeah. And in management audit, what the auditor has to do, he has to check whether the management is getting relevant information to make informed decisions or not. He has not been there to audit the management decisions. He has been there to evaluate whether the management is getting all the relevant information to make informed decisions or not. And how do you organize, or how do you do a management audit is, first thing, devising a statement of policy, like what is the scope and what's the objectives and what are the management objectives and what's the scope of that management audit. Second thing, the location of the audit function within the organization, with information with regards to which function, and with regards to allocation of personnel, that is our audit firm personnel, and we have to give training to them. And then nature, timing, and extent. Then we have to also decide the time and the frequency. In what frequency, like for 1 year, for how many times for an year, or how many times for how many years, have to do that. And this is with regard to a small short note on management audit. And now we'll move on with commissions paid to agents. And here is an MTP question with regards to that. Just a short note on commissions payable to the agent and how you do audit for that. Insurance business. First, you have to give a brief introduction that insurance business, it usually pay commissions to its agent, which forms a significant portion of its expenses. And this commission is payable as a percentage to the premium that were collected by them. Okay, and these were two to three points, like the source, on what basis the payment was done, how significant it is, and why it is paid. And the commission is payable towards generation of new business and towards settlement of renewal premium. That is for the new first insurance premium that the and pays, and for renewals, like for the next year, subsequent years, they'll get also or renewal premiums. On both, they'll get the commission. And what the role of the auditor, they have to mainly focus on review of the system that was established by the insurance company with respect to the calculation of commission, that is on what basis, whether if it is for the new business, how much percentage of the commission to the agent, and it's for a settlement of renewal premium, what percentage. They have to review the system that was established by the insurance company and review the commission payment system. The rules have to be reviewed, and how they have been implementing the payment system also have to be reviewed. And they have to be in sync with the premium collection, because this commission payments were based on a percentage of the premium collected, right? So we have to review the sync with the premium collected by those agents and the commissions that they get. And if there were any cancelled policy, whether we have to check whether the commission was clawed back, that is whether the commission has been stopped with that cancelled policies or not. We have to check that. And we also have to check whether the commission that was paid was within the prescribed limit of the Insurance Act or not. Only 4 points. First, we have to check the rules and regulations, and then the amount with sync to the premium collection, and if that all we have cancelled, whether the commission has been clawed back, and whether it's as per act or not. That's it. 5 marks in your bag. And now we'll see CAAT's approach and various risks in the automated environment. Good morning, Sam. I'm Ria, face of Samaya. Special aspects of auditing in an automated environment, CA Final Syllabus. An automated environment is an ecosystem that combines people, process, and technology within a business environment. It's driven by computer-based systems, information, and information systems. We know that automated environment is something which auditing more efficiently. And people, and what does it consist of? It consists of people. It consists of some predetermined process that has to be followed by such people, and technology through which they follow the process that were there. And while talking about technology more, Technology is nothing but some applications through which they access the data that was there and or do the process that was defined by such people. So business applications are of three types. There's package software, small ERPs, and ERPs. Package software is mostly opted by micro and small enterprises which are not customized or not mostly tailor-made. That was like Tally and QuickBooks. Small ERPs are for small and medium enterprises which have some not tailored one but have some specified or custom modules depending upon the area or industry that were working that they were in. ERPs were used by mostly medium and large enterprise which were tailor-made like SAP, ECC, Oracle, Business Suite, etc. An automated environment consists of the following layers. I think you could expect this as a direct question or an application-based question where you have to point out what are all those database. We go from micro to macro level. Database or operating system, application, networks, and physical and environmental physical and environmental. Database, if you think of a database, the PDF that you're reading right now, operating system is a Windows that was in the system, and application is the software that I'm using to open the software that I'm using to open that PDF. That is like would be a Adobe, Dropboard, etc. And network is the network through which we are connecting. LAN is used mostly in big corporates for private networks. WAN is the Wi-Fi that we normally use. VPN, virtual private network.
Physical and environmental is the keyboard or mouse or monitor or the camera that we are using right now. The next topic in automated environment is the real-time environment. The real-time environment is that it gets initiated, processed, and recorded immediately, like a GPA transactions. As soon as we initiate that split price bill 30 rupees to your friend, and it gets immediately processed and reflected as credited to your friend account, and then recorded in your books and his books.
So, what are all the components? What are all the ID components that were used to make that real-time environment live? Is that application like GPay or Paytm or Beam UPI, etc. And middleware is a bank servers, and networks is a Wi-Fi or mobile data, and hardware is the mobile or the laptop that your mobile laptop tab that that through which you are accessing your applications. We have seen this real-time environment in individual point of view, but for the corporates, we are auditing corporates, right? For the corporates, it would be that GPay would be Oracle Business Suite or CBS, like for the banks and SAPs, etc. And middleware is the networks or source web servers like Oracle Fusion, IIS, Apache. What is mostly thing middleware is that, in order to give you a brief point, it's like if you have various branches and wanted to know which product is out of stock or so that you could communicate with your supplier. It's like your supplier network and your retail branch network and your head office network to initiate the transaction have been connected. This is a middleware. Through how do you connect? It's again Wi-Fi, local area network, and wide area networks. For the example that we have seen for the retail shops and suppliers, we use wide area networks. For the HO like purchase department and accounts department, we use private networks, local area networks. Hardware, obviously data center servers, storage devices, monitors, etc. Any failure in one component, applications, middleware, network, any failure in one component could render real-time system unavailable. Obviously, right? We have so bring it back to a GPay transaction. Bank servers not there. Mobile data was not there. And again, you don't have mobile itself, and you do not have any kind of applications. The most real-time and environment and accessible through public domains and internet, hence vulnerable to network and cyber attacks. Why this point? This point is for the risks that there were like restrictions. The restriction, so that if any component that was not there in the following components like application, middleware, and networks, real-time system is not available. That's a restriction that a real-time real-time environment has, real-time system has. And what is the risk that real-time system has is that network and cyber attacks. This is a restriction, this is a risk, and how to overcome this hits here. Identify and resolve the issues and failures. You have to constantly monitor. This is what the remedial action is. understanding and documenting the automated environment. The next chapter is, have you heard like similar things like in standards in 300 series, right? We have to understand and understanding the business environment, including internal controls. SA 300 series. The auditor understanding the automated environment should include the application that are being used, IT infrastructure, IT components, organization structure, policies, IT risks and controls. For these two are like macro. This is a gray area, that IT risks and controls. Wherever there was an IT, there have to be a special consideration for the risks and controls that were being used. Mostly, you could see that in audit of banks, like mostly. They were merely telling about the components, applications, infrastructure, organization, policies, and risks. So easy. And SA 230 is like documenting automated environment. How do you document? I think if you're in Big Four article, I need not stress more about documenting than you all know. Like real-time environment components, IT components, you have to, what are you have to document? It's the same thing like IT components. What are the applications that are using? What is the middleware they are using? And what are the networks? And what's the hardware they have? Considerations for automated environment. For any audit, there were 3 steps. There's planning, execution, and completion. That was same for all audits. So what's the special thing is that those steps were also the same, like risk assessment, that is 200 series, understand and evaluate 300 series. As for operating effectiveness is also like 200 testing and of operating effectiveness. It's nothing but the internal efficiency, internal controls efficiency. This is 700 series. And what's the risk assessment that we have to see in an automated environment is like, what do they do? What do we see in 200 series? We see were there any audit risk from the financial statements or the audit reports of previous auditor, significant accounts and disclosures, and quantitative and qualitative considerations. All the key points in 200 series. We're going to soon discuss the 200 series. It's not about the direct question, it's about the applications questions. We have to know what are all the key points or what are the topics that would get used in this 200 series. When have to we mention that question? When have to mention that relevant points in 200 series in that particular question? We're going to soon discuss that. But before that, we just when financial statement assertion. These were the assertions that the management has been given. Identify the sources of misstatements. Written representations from we could get that from written representations from the management or TCWG. And the risk of IT, wherever there was IT, you have to write like a risk. And for the second step, understanding and evaluation, you have to document the business process in flowchart narratives and risk control matrices. This is a single point, but in a different kind of way. Understand and design the process through walkthrough. This is a saying, they were saying the presentation portion here. And here they were saying the process that has to be followed. And here entry-level controls and segregation of duties is internal controls and general IT controls and application. We're going to soon in this video go more detail about that. Testing of operating effectiveness, it's like whenever there was an internal controls testing, we need to have nature, timing, and extent, and source of reliability of the source data, and testing of report, sample testing, and competence of independence of staff. Or why such independence of staff was more is that the frauds that the staff does is easily identified than they were properly curated by management. They were very well designed so that it couldn't get that. We have to test the independence of the staff also. Reporting is a 700 series. You need to have the evaluate control deficiencies or its internal control deficiency, as we have been testing the internal controls all over here, and any significant deficiencies and material weaknesses. And these two were all internal controls and remedial. After we see, after we tell something that was risky or restrictions, like here, like this was a restriction and this is a risk, we immediately said the remedial action. Likewise, when we find out some deficiencies or weaknesses or any kind of risks that were there, we immediately say the remedial actions. And internal control memo or management letter, internal controls memorandum, and then auditor's report. The second thing is enterprise risk management. Due to dynamic environment, the associated risks have increased and the companies have continuously managed the risk. Obviously, the main duty of CEO is to mitigate the risk and manage the risk of the business. And what are all the risks that we have to consider is this, technology and security. why there was security and technology? Because of privacy, because of privacy concerns. Here, what they have said, network and cyber attacks, that was what security of data. Environmental risk is for the carbon footprints, environmental risk, the carbon footprints that were, and regulatory compliance. When there were regulators, we have to comply in something. So there was compliance risk also exists whenever there was a regulatory. Market risk, operational risk, financial risk, credit risk, etc. ERM is a formal program that is implemented across an enterprise for enabling risk management. Risk management is a combination of process, people, tools, and techniques. Have you heard these three before? It's an automated environment, is an ecosystem, combines people, process, and technology. Here, the same thing, but they were telling it as tools and techniques within the company to identify, assess, respond, mitigate, and monitor risk. Any risk that has to be identified. 4 to 200 series. Any risk that has to be identified, and we have to assess that. That means quantifying whether it's quantifying like more risk or not, and what do auditor has to do? Auditor has to respond. And what meetings? Whenever we see, we have to what? Mitigate or put remedial actions. With remedial actions, we could mitigate that. And then for consistency, it's not a one-time deal. It's a continuous process. Business goes on continuous, and remedial actions also should be monitored. PRM is so risk management is a combination of process, people, tools, and techniques through which company it identify risk, assess risk, respond to risk, mitigate risk, and monitor risk. ERM is implemented by Board of Director, TCWG, or employees by way of board report, internal control report. Also, ERM is most common for implementing suitable ERM. It's just an information who is going to implement that. When there is a responsibility, who has to implement that, right? Considerations for risk assessment process. Anything risk, whenever there's a risk assessment process, the risk stands in the first place. We have to prioritize the risk, and risk has to be identified. Identify the risk and indicators, like you have to assess what you have to assess, how you could assess. You could assess by risk indicators, risk appetite, risk scales and scores, and then assess the risk. With the use of that, that's the second step that has to be done. And how do you respond? You respond to the use of data and metrics and qualitative and quantitative factors, and then mitigate by benchmarking and key performance, and then monitor the risk. This is how you maintain or have to see the risk assessment process. First, you have in order to investor, if you're a portfolio manager, you have to identify first your investor's risk appetite, or how much A amount he wanted in T time. Likewise, define the business objectives and goals, and identify the events and achievements of business objectives. The same with the market trends, stock market trends, or the new instruments that have been introduced into the market, and assess the likelihood and impact. Like increasing interest rate or decrease return, or might likewise. You have to assess such events and impact to our objectives or goals. And whenever, as we all said, was a key rule, whenever you find any restriction risk, you have to respond and then mitigate the risk, and then assess the residual risk, because after mitigating, you still left with some risk. It's like mitigating, not eradicating. Consideration while assessing the risk assessment. Entity level aspects of risk, like governance, organization, and management of IT. Risk in IT process and procedures have been followed. IT risk at each layer of automated environment. Have you come across this? If so, here it is. Understanding and documenting automated environment, organization, policies, and IT risk. Right? The same way. Controls on to mitigate IT risk. How do you control to mitigate IT risk? Is that whenever there's IT, there's risk. Whenever there's a risk, you have to respond and then mitigate that risk. How do you use that is general IT controls, application controls, IT dependent controls. General IT controls are also known as pervasive controls or indirect controls. General IT controls are policies and procedures that relate to many applications and support the effective functioning of application controls. They apply to mainframe, miniframe, and end user environment. General IT controls maintain integrity of information, security of data over pandas. What are the pandas? Program change, application system acquisition, development and maintenance, data centers and network operations, access security, system software acquisition and maintenance. Okay. In order to find a situation for us to relate is that What are those? Who all could access the systems, and what are all the applications that they could access in an overall business environment? Application controls. They include both automated and manual controls that operate at a business process level. Automated application controls are embedded into IT applications and help in ensuring the completeness, accuracy, and integrity of data in those systems. IT dependent controls. They are manual controls which make use of data information report system from IT systems and application. Its design and effectiveness depends upon reliability of source data. In order to relate this IT internal general IT controls, we could think of our tally, like who could start a company in tally. And for the application controls, who could enter the entries into the tally, and IT dependent controls is the who could use the reports or data in order data into such tally. Entity level risks and controls. The controls that operate across the company, whenever any controls that operate across the company, they are pervasive controls. And at all levels from board and top management to department and transaction level. PLCs are a part of internal control framework and relate to internal control components other than control activities. PLC system nature, so required application for more professional judgment. There are two types of PLCs entity level controls. First, operate at a higher level than the business activity like code of conduct or prospectus or memorandum, such as a business process, sub-business process, account level at a sufficient level to prevent, detect, or correct in a timely manner. Direct ELCs operate at a higher level than business activity or transaction level, such as business process or sub-business process or account balance level or at sufficient level or at a sufficient level of precision to prevent or detect or correct a misstatement in a timely manner. Example like business process reviews, like we have seen in SEBI, right? If you remember that balance scorecards, etc., and any kind of monitoring of effectiveness of control activities in internal audit function. And indirect analysis do not relate to specific business process or transaction or account balance level, so cannot prevent detect misstatements. They contribute indirectly to the operating effective operation of direct ELCs and other control. Direct ELCs operate at a higher level than business activities or transaction levels, such as business process or sub-business process, account balance level, or at a sufficient level of precision to prevent, detect, or correct a misstatement in a timely manner. Prevent, detect, correct a misstatement in a timely manner. Like business process reviews, in SCMP, if we see balance scorecards, business process reviews, etc., and monitoring and affecting control activities at internal by internal audit function. And indirect ELCs, they actually do not relate it to specific business process or transaction or account balance level. So they cannot prevent, detect, or correct a misstatement. They contribute indirectly to effective operation of direct ELCs, like code of conduct and HR policy, job roles, etc. And the next topic here is that whistleblower policy. So whistleblower policy comes into picture when there was any fraud that was happening in a company. Whistleblower policy through a small questionnaire, and the questionnaire is that we have to first the first part is that existence, whether the company had a whistleblower policy, yes or no. Is the company documented and approved, whether it was legally enforceable? Not so it is documented and approved. Has the whistleblower policy been communicated to all employees? The the main beauty of the whistleblower policy comes into existence when it is used by the employees of the organization. So in order to use the whistleblower policy, it has to be first communicated to all its employees, and all the employees should be aware and understand its purpose. It's not that, okay, whistleblower policy is that, but how do you apply that by knowing its purpose and its obligation towards the employees? Has the company taken measurements for training the employees to understand the contents and purpose of all this? Yeah, the employees were aware. If not, employees were there. And what are all the steps that were taken by company to make their employees understand? First thing, whistleblower policy there or not there? It is approved or not approved? Communicated, not communicated? Okay. Do they know the purpose and obligations? Yes or no? Does company have taken any kind of training to its employees to make them understand the whistleblower policy? Does the company monitor? After, whenever it's a remedial action, as we have discussed earlier, whenever there was a remedial action, we have to write about the monitoring the thing. Since if you think fraud is a risk, whistleblower policy is a remedial action, and the company has to monitor the effectiveness. How does a company deal with any deviations and non-compliance? Whenever there are obligations, there might exist some non-compliance. How the company is dealing with such non-compliance? And now entity level risk, right? Now you're going to see the process level risk and control. As per SA 315, auditor has to understand the business process that makes, right? So try to not take gist of this PDF. This was already a gist of study material, and don't worry, no topic or no keyword has been omitted from study material. All the gist have been come. All the gist of study material had come into this PDF. You just why this PDF is that we have a very limited time before the exam. That's just 1.5 day. That's just 1.5 day. We have to grasp as much quickly as possible. We have to grasp the material or revise or retrieve the things as fast as possible. So we have to be more. We don't have time for all the unnecessary things that doesn't matter in the examination. What is in the PDF is completely more than enough for your examination. You have to do question. You could take any question bank. A question bank is not necessary. With some particular question banks and all. It's more retrieval process. For the retrieval process, I think Samaya would help further. I think Samaya would bring up with some new remedial actions, because ICA do not award you marks for the number of revisions you have done or number of hours you study. It only award you marks for your retrieval capacity, how much you have put your answer into the paper. So try to retrieve as much as possible. Know what have to be retrieved and what question. That is the main important point. You have to write correct relevant answer for your question in your examination. So you need to have a bit of practice for that question bank. You have to definitely do your question bank after watching this revision video. SA 315, auditor has to understand the business process that makes up account balance or financial statement line item. Process level risks and controls. As per SA 315, auditor has to understand the business process that makes up account balance or financial statement line item. What is a financial statement line item or account balance? Is the debtors, creditors, lands and buildings, travel expenditure, etc. The business process is a sequence of activities. As per 315, auditor has to understand the business process that makes up account balance. How do he know? Through walk through process. We have seen it here, right? Walk through. It might come in an MCQ. It's that. Account balance or financial statement line item. It's like debtors, land and building. That's no. A business process is a sequence of activities that takes place from initiation of transaction, recording, approving, posting, and reporting. For the real-time environment, we have seen a similar kind of series of events like initiation, process, and record. Here, they are saying it in a bit different way, but mostly the same. Initiation, recording, approving, posting, and reporting. After initiation, you got recording. Why? Because that we have seen it in individual point of view. Here, it's mostly in the big corporates. You need reporting for everything. You need to have approval for everything, and then reporting. The business process is a typical. A business process is typically made up of sub-process, a logical grouping of related activities. It's just a adjective on adjective. The auditor should document this understanding of company's business process and flow of transaction in audit file. As per 230. 230, we have seen it somewhere documenting. Data analytics. Data analytics, it's like analyzing the database. Database is a layer of automated environment, which is an integrated component of any kind of business. Data stored and processed can be used to get various insights. This data can be useful for preparation of MIS reports, high level of snapshot of business performance. Data stored and processed can be used to get various insights. Obviously, that's right. This data can be useful for preparation of MIS reports and electronic dashboards. MIS reports was like what we CS do mostly in industries after we get qualified. If you have been into any generating and preparing meaningful information from raw system data and using process tools and techniques. Have you heard this before? Automated environment, people, process, tools, and techniques. That's technology and tools are. We have seen this in tools and techniques. It's known as data analytics. Nothing but raw data you're converting into meaningful information through process and tools and techniques. Data analytics is an audit, also known as CAAT, computer assisted auditing techniques. What are the components of aspects where what are the, what are the areas that CAAT could be used? Friend seeking, friend fraud, friend fraud risk assessment, evaluation of deficiencies, non-standard journal entries, control testing, and preliminary analytics. This could be a direct question. You have to memorize the way it is. We find a mnemonic here. It's something that was direct and it has of it. But always remember, you have to retrieve the correct information. You have to retrieve the correct information for the question. That's the main aspect. Fraud risk assessment. For risk assessment, evaluation of deficiencies, non-standard journal entries, control testing, preliminary active analytics. One more time. Fraud risk assessment, evaluation of deficiencies, non-standard journal entries, control testing, and preliminary analytics. And what's the audit approach to use the CAATs? First, you have to understand the business environment, including IT 300 series. You have to define the objectives and criteria, identify source and format data, extract data, verify the completeness and accuracy of extracted data, apply criteria on data obtained, validate and confirm results, report and document results and conclusions. 230. 300 series, wherever we started, 300 series and 230. Here we have started with 300 series and ended with 230 documentation. Okay, how do you memorize this? Again, because you have to understand the business environment. 300 starting point and ending point will be the same, and you have to define the objectives and criteria. You have to, because you're discussing more about data, you have to identify the source and then the format of data, and you have to extract the data. Obviously, that might be a raw data, right? You have to extract and verify the completeness and accuracy, and apply criteria is nothing but filters. Mostly, in order to sync it with our day-to-day life, is that applying filters to Excel data and validate and confirm results, reporting document. And here is a glossary that we could look it into. And as we have completed automated environment, we'll just move on with the fair valuation. It is nothing but, or in it would, you will mostly see that in audit of banks and insurance audit, where mostly there were few kinds of securities which were maintained by the banks or those entities, which were, if at all they were actively traded, you have to measure them at a fair value cost. And if at all they were not actively traded, you have to measure that at a historical cost, like same as a real estate or investment property. Even that has to be maintained at a historical cost. How you know whether a security was actively traded or not? If at all, the trading volume does not exceed 10,000 units in any trading session during the past 12 months. That is not an aggregate. That is one trading session, it has to exceed at least 10,000 units. That is when it touches 10,000 units, then also it is not actively traded. When it exceeds 10,000 units in any trading session, not overall or aggregate in last 12 months, in any trading session in last 12 months, then it was treated as a thinly traded and you could record that investment in historical cost. And now we'll move on with the next topic, that is indicators of significant deficiencies in internal control. We'll see that one first. We see what is a significant deficiency in an internal control. In deficiency or a combination of deficiencies in internal control system that in auditor's professional judgment is sufficiently important to merit the attention of TCWG. That is why communicating with TCWG, it is sufficiently important to drag the attention of the TCWG with that kind of significant deficiencies in the internal controls. You see, what are all those significant deficiencies were? The deficiencies leading to any material misstatements in the financial statements, first one, or it could be a suspectability of fraud for a related asset or liability. First thing, material misstatement, and second thing, any loss or fraud for, with respect to any kind of asset or liability. Third thing, subjectivity and complexity of determining estimates amounts and such fair value accounting systems. You see, there was a lot of subjectivity. The management has to make accounting estimates objectively. They have to not make the estimates or anything with regards to subjectivity. That is, subjectivity is being biased. Okay, and it should not be complicated. It should be a widely used format or widely used method. It would be more regular. When they use subjectivity and complexity while determining the estimated amounts, there is something that deficiency that has been going on with regards to the management. You have to check that. And volume of the activity that had occurred or could occurred in the account balance that is exposed to the deficiency or deficiency, that is a particular volume of those transactions, like 100 transactions, or those could and as of from this particular time period, like say had been a deficiency in the internal control for a period of 3 months, say, and we have to give we have to draw the attention of TCWG with regards to those 3 months volume activities to the TCWG, and significant transaction in which management is financially interested in. You see, management has involved in things here while doing accounting estimates, when there was subjectivity, when they show subjectivity and complexity, and they have been involved in a transaction in which they were financially interested in, and out of which management fraud indication was there, and absence of risk assessment process within the entity has to assess the risk, whether the financial statements were prepared in the proper environment or not, whether what all the possible risks that could happen in entity, management has to do assess that. That is what design, implementation, and monitoring of internal controls we talk about. That's responsibility of the management. 4 points with the management: absence of risk assessment process, management fraud, and transactions which management was financially involved in, and subjectivity and complexity in the estimates amounts, and any kind of volume of activities and indication of any loss of fraud or risk of material misstatement. These were the significant deficiencies of internal controls. And now we'll discuss the evaluation and assessment of a well-defined SOPs. It was an RTP question, and we'll just see that, yes. Uh, how should be in a well defined set SOPs has to be. First of all, what is the definition of them is, it is a what it conveys is the roles and responsibilities and process and controls which should be clearly communicating to the operating controls which touch all points of the process. It should communicate, it should define the roles, responsibilities, and it should define the process and controls, and it should clearly communicate operating controls of that, and these controls are likely to be understood and consistently applied even during the employee turnover. That is, even there were changes in the employees also have to be clearly consistently applied. And with regards to the enterprise risk management, it's a organization which has robust process to identify and mitigate the risk, that is, they're managing the risk to an acceptably low level with the risk that was they found in the enterprise. And with a what they have to make a periodical review which would assess the identification of the gaps and take control measures, effective control measures, as we have discussed in far videos, that what's a golden rule. Whenever we find any kind of risk, fraud, or irregularity, they have to put the remedial actions there, and that's they have been applied it here. You see, audit is mostly like a behavioral science, which were mostly done under few bases, few rules and regulations, which we'll discuss in further classes. And with regards to the segregation of job responsibilities, Why segregation of duties? This is mostly you see it in audit of banks, right? You'll know, or you could write answer from that also. The main thing is that multiple activities or transactions should not be concentrated by only one individual. That has to be some division of responsibilities so that there would be likely the fraud or error would be happening less. And the same with regards to the job rotation in sensitive areas. Sensitive areas is like for any cash in, with respect to the bank, etc., and any cash receipts. And the delegation in the financial power document, there also has to be clearly defined what are all the powers that the controls allow. And information technology based controls with regards to the ERP systems or the SAPs that were implemented in the business, and who all could authorize the changes to the entries and all. This is an important question. Do read this if you haven't done that so. And our last topic is audit procedures with regards to account balances. Again, it's an MTP question. See, in this question, what they're talking about is that 35% of the purchases that were made by the entity were made without a valid purchase orders. How the auditor, what all the audit procedure that the auditor has to do in order to address the validity of the accounting balance, account balances with regards to that. You see, first they have to select the purchases, select the 35% purchases, and review the correspondence with the vendors from whom they have purchased that. That is going back the transaction and purchase requisitions, any kind of internal documents. That was whenever there's a demand, whenever there's only a demand, right? Like, say, for a JIT system, just in time system under SCMPE, the same thing. When there was an internal requirement, then only we'll make a purchase. Whether there's any such internal document, and reconciliation of their accounts has to be done for the vendors and the purchases and the purchase requisitions. That's one thing that the auditor has to do. And second thing is review vendor listing along with aging details. We have to check. So we have seen the vendor list, right? We have to check the aging details also, whether whether we have been paying to the vendor, or we have been not paying, and how the what the payments with regards to the vendor were, and meet the company's purchase officer and obtain responses to our inquiries with regards to the purchases that were made without purchase order. First thing, we have to make some reconciliation with the purchases and with regards to the vendors who what they have done, and the internal requisitions, and reconcile those accounts. And second thing is the aging details of the vendors. And the third one is we have to inquire the company's purchase officer why they have made the purchases without a purchase order, and discuss the summary and issues with the client, that is the management. And that is, we have completed our frantic cover, and we'll also discuss all the important questions. Stay tuned and do subscribe. Please do subscribe and share it with your friends. It would be very helpful. And there's a surprise waiting for you. I'll meet with you the surprise then.